Audio check. Audio check. Audio check. Come on. Audio check. Oh, I think I got it now.
Audio check.
Good grief. Well, good morning, folks. Having some technical difficulties here with this OBS. I have a little bit of a raspy voice today because of allergy season, so just make do with it, okay? All right, so real quick, let's put a risk disclaimer up here. All right, so we have our NASDAQ. We're going to be looking at NASDAQ and probably toggle between NQ and ES for about 90 minutes. I'll stay with you till around 10 o'clock. So we've had the initial data released at 8:30. I was trying to get this thing to start running, and it wouldn't let me get the audio synced up. So if anybody uses OBS, you probably know what I'm referring to. Sometimes when you try to find or capture a window, so that way you can share what your screen should be showing, or if you try to connect an audio device, it would populate in OBS, but it wouldn't actually do anything. So that's what I was battling. We have sell side resting just below the 18,055 level. It looks like it wants to sweep that. The 4 hour drop up into that level. Below that, if it wants to get overzealous, we have sell side right in here. So any animation below these relative equal lows, that's that level right there. Okay, so it's not much. It wouldn't take very much effort for it to get below here to reach below that. I'm wanting to watch and see how we behaved this morning before the opening bell at 9:30. So it's a lot of time between now and then for price action to do a number of different things. When it comes to PPI or CPI number, those reports, they're very difficult to anticipate what the move's going to be. So the way I do it is I look for what it tries to do, and you're probably going to hear the puppies in the background because they're kenneled next to me. So, and if I don't have them in the kennel, they'll be crawling all over Tommy. So the report that comes out for either PPI or CPI, I want to watch and see which liquidity they run for at the time of the release. Okay, so I like the buy side up here, here, and here, because I have not abandoned the long-term bullishness of the marketplace. These reports are heavily manipulative. They're classically used to run out a major pool of liquidity, and then the other side of the coin is shown later in the day or the next day. So I'm not trying to build the case that we're going to go for any one particular liquidity before. Now, I've done it in the past. I've done it when I was on Twitter, which I'm not on Twitter. I'm not on Instagram, by the way. There's people out there pretending to be me. The only social media I have is this here. Okay, so if anyone's talking to you pretending to be me, if I'm not talking to you audibly through my live streams here or from a video I posted on my YouTube channel, that's officially got a little check mark that's Inner Circle Trader, you're listening to someone that is pretending to be me. But I use these reports to try to build a premise to what I should expect, and then try to formulate a narrative. Why would the market want to go to a particular price level? And this is all cluttered up. These are notes that I have to use because I'm going to try to use this time today to explain what I did the other day, but got backed up with personal things. So what I'm watching for is, does it have the interest to get down to, at the very minimum, below here? And if it does it want to run below here? And then does it want to come all the way back up and eat all the way back up into this to work into later in the week where we attack all this up here? There's a lot of people that have made money from this drop if they weathered this retracement here back up into this high, but not taking the high out. This, I don't want to go so far as say someone was smart enough to go short, because if you're trying to trade ahead of these types of reports, PPI, CPI, or anything like an FOMC report, you really are gambling. And that's not skill. That's gambling. It's no different from you sitting down the, a roulette table or baccarat or, for the life of me, every single time I try to remember what these things are called, slot machines. You don't know the outcome of that, okay? And you don't know the outcome of what they're going to do and how the market's going to behave at these reports. So to try to pretend you do know, that's foolishness, okay? And I've been doing it long enough to know that no one's consistently able to do that part of this, and it's so heavily manipulated. There's better ways to trade. There's better times to take a trade. So what I do is I sit back and I relax and watch and see what does it want to do. And anything that it leaves after the fact, okay, so it's been now 11 minutes or so since the report has been released to the marketplace, and it's been a straight shot lower. It's interesting to see how they have not, as much as they dropped it here, they did not take out these lows here. See that? So I'll make it a little contrasting color. This is the very minimum I want to see it trade to, and below that. If we take out this low, if we get below here and we really expand down below that, I want to see, does it want to have the ability to come back up and then back above this low? And then I'll look at some of this range in here. It may be as much as 50 to 60% of that range. That would be what I would expect if it were to do this. Now, again, let me preface it by saying, again, it's contingent upon it going through this low and then reaching below that low. That what I'm about to say is what I would expect during the opening range after 9:30. So the opening range is between 9:30 in the morning and 10 a.m. Eastern Standard Time. So whatever the local time is in New York, that's the time I'm referring to. That's what the time is set down here as well. So if you are ever in doubt as to what you should be looking for in terms of time, it should always be, I don't care where you live in the world, this is what your time should be set to. Okay, do not set it to your local time, because you won't be able to follow the things I've outlined on this channel, in the notes, in the presentations, and obviously during the live commentary. You have to be able to do this stuff consistently and find the routines and mannerisms that the price action usually tends to follow. Not always, but most of the time. So with all that jawboning, if we get below these lows and then stab below this level here, which is that low, what's so important about that? Well, we've already swept this low, went below here, and we created that low. And this pass down did not take out that low. So there's a huge pool of liquidity in the form of sell stops for anyone that has built in long positions prior to this low forming, maybe back here or even further to the left. They have moved their stop loss below that low. And they did not see that get traded to here, 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 and as of yet today, we have not seen it trade to it as well. So there's a lot of opportunity for the market to seek liquidity lower than where we are if we can just get down to this level here. Okay, so it makes no sense for me as someone that's studied price action for over 3 decades to anticipate the market just to stop here because that's where it stopped before, because that's support and resistance. I don't subscribe to that view. The idea is that if it's going to go down here, it should reach below that because there's real orders resting below that in the form of sell stops, just like there's a larger pool of liquidity here. So that's why I drew your attention from not just here, because these are relatively equal and you can see that visually. But why do I sometimes point to a low or a high beyond the relative equal highs or lows? Well, it's because of this basis here, what I've just outlined. This is where you build a premise. Okay, if the market's in a hurry, like we've seen it move since 8:30, it's reaching for something. It's not buying and selling pressure, because who's really trying to get short ahead of that report? Nobody in their right mind is trying to do that. Okay, so, and it's not a void of liquidity, as sometimes it's been taught. It is algorithmic. It's reaching aggressively, driven by time, then price, always in that order: time, then price. The move is not going to happen until it's been scheduled to move. That's what makes these markets highly manipulative, and they're absolutely controlled. They're not left to our whims and wishes. And if we could muscle the market, collectively, we would have crashed the market, okay, or the market would have went, to the stratosphere. Because those things are not seen and they're not evident, and you study all these things for a period of time that's measurable, not just a weekend or binge watch a couple of videos and say, oh, I think I understand this. You have to study it in great detail, log a lot of data, charts, screenshots, watch real price action, study it, and you'll see these mannerisms. They tend to repeat all around specific elements of time. And if we can collectively agree that the market is ranging here since March, we've been just hammering inside of this larger trading range. Now, even if we're going higher, say we're higher going into the end of the month, going into May, and then we get a respectable retracement. I'm not calling it a crash. I'm not calling it the bear market. I'm just saying between now and mid-May or so, I'm expecting something of a respectable retracement. And while that's not limiting and only making an allowance for only going short, what I'm suggesting is I'm not trying to get too permeable, but I'm not ignoring the fact that we could have, or we're about to form an intermediate term high where it can retrace. Now, it's an election year. Things tend to go out the window in those years. So where we see classical seasonal tendencies in the fall, in the spring, where we usually get a long protracted retracement in the spring going into the late summer months into fall, making the fall low sometimes between the last week of August, if it's really, really bullish. And I don't see us having a really, really bullish market right now. All of this stuff that we're seeing with the market going up right now is absolutely 100% artificial. None of this move up is genuine. Okay. And I know some of you that trade stock and some of you are, perma bulls, you'll want to argue and debate that. And we can agree to disagree. Okay. But this market has been absolutely driven by the Fed. And we can talk about it until the cows come home. I'm not going to convince you if you're against the idea of it, but that's really what's going on. The Fed's just pumping this up. At some point in the future, real soon, things are going to have to sort themselves out. And it's being built up in a manner where when it does come home to roost, it's going to be fast and furious and bad. Okay. And it may not be tradable. It may be, in a manner where, you're just smoked and that's it. So I'm trying to balance all these things, because if you look around in the United States, things are not going like they should. And even Democrats are waking up and saying, what the hell is going on here? This isn't my country. What's going on here? And all these things, these policies, all these um, control measures that are being implemented in unconstitutional ways, things that are being changed financially, taxes and things that are being, you know, proposed to come against us. You know, this bastion that we're all basking in right now, which is trading. I mentioned in many Twitter spaces that this isn't going to be exempt, and it's nice for us to be able to sit down and watch these squiggly lines and come up with an idea where, we're trying to predict the future and somehow profit from that. That's a way to make money outside of the 9 to 5 grind that they want everybody chained to. And some of you are championing all these ideas about minimum wage being raised to $20 in California. Well, that means your French fries and your hamburger is going to go up a lot more, and everything else is going to go up more. So you're not going to outpace it. It's designed to cause all kinds of difficulties. And some of you have noticed what I've also mentioned in the Twitter spaces, that these funded account companies, have you noticed how some of them are having difficulty? And have you noticed that I have students that are raping them over and over and over again? That can't go on for a long period of time. And the more people that learn how to trade and are able to be consistent, to me, and just a shout out to Matt, Trades by Matt. I saw your thumbnail. Apparently, you're smashing it. Well done, lad. Well done. The That type of thing is unsustainable if the growth of the traders, because let's be honest, okay, these folks are making their money from the resets and the purchases of the attempts to do so. And over time, traders that invest time and do their due diligence to learn how to trade these markets, they will overcome that model. They will. And especially if a small group of them are collectively doing the same type of thing, if they have like a hive mindset and they're doing those 20 accounts. And look what Trade by Matt has been doing. Apparently he's only doing a small little sliver of a move, but he's doing it compounded by like 20 accounts. And if you're doing that, and he's not aiming for a lot, which is exactly what I said before. I'm not saying he's trading my information, so don't take that out of context. But I'm saying all you need is a small little cookie cutter. One little cookie cutter, that mold. If you can find one thing that repeats for you, then you multiply that. And that's done by money management. Well, since you're not really trading with real money in these funded accounts, you're purchasing the participation in up to, and if my understanding is correct, if I'm correct, I did watch a video a month ago, and he was stating that he was working with 20 accounts. I don't know all the dynamics with it. I've never done a funded account. I never would do it either. But whatever he does in one account, it's being copied. And that small little move of $200, less than $300 or whatever, over 20 accounts, he gets it and then he stops. That's discipline. That's not a gambler. That's someone that's looking for their little, it's a cookie cutter shark. I've used this analogy too. A cookie cutter shark is like this little sea snake looking fish thing. It runs up on anybody. Any fish that's in the ocean, that it's opportunity to eat something. It runs up, slams into it, bites a circle piece of flesh out of its body, and it runs away. It don't snack and hang out and have a cookout. It's going in there, hitting it, boom, circle strike. It's out. It's got its meal. It's gone. That's what a professionally minded trader does. They're not in here trying to do 15 trades so they can go on social media and say, look what I did. They're not in here trying to do feats and wonders to look like an ace in front of everyone. They're going in there, taking 1 pound of flesh, their pound of flesh, getting it done, and I'm leaving. They're not looking to see how many times they can get it right in a day. They're not trying to make a specific dollar amount for the dollar's sake. They're looking for a low threshold objective, a very low hanging fruit objective. And when that's achieved, they're done. They move to the sidelines and they wait for another day, another opportunity. And they're not in a rush to get in there just because it's a new day. The bell rang. It's 9:30, or it's been 30 minutes and now it's done doing its opening range. Now there has to be a trade, or there has to be an entry for me because ICT said there's a fair value gap silver bullet trade between 10 o'clock and 11 o'clock every single day. There is, but it might not be on the lower time frame, less than 1 minute that you're studying, or you might not have the aptitude to see it real time, and you'll be able to see it after the fact, and it'll probably be a means of frustration for you because you should have saw it in your mind. You should have saw it real time when you haven't done this enough to have the experience to see it real time. And that's the part that growing pain. A lot of you don't want to go through that, and there's no way around it. You can't circumvent that. You can't shortcut it. You can't buy a book or a course or someone else is reading or watching my videos and they're going to give you the Cliff Notes version of it. That shit doesn't work. It does not work. They'll sell it to you like it is, but you'll find out with the results, it doesn't work like that. So you have to go through that grind. You have to go through it. So when we're looking at price action, we're looking for, number one, there has to be a premise to why the price should be doing anything. And that gets back to, should this be a large range day? Should this be a small range day? Should this be basically an indecision day where price is indecisive about where it wants to go higher or lower? Okay. That takes some experience. You generally looking at higher time frame charts, monthly, weekly, daily, and getting a feel for what the market tends to do on those higher time frames. It doesn't take very long to do that measure of perspective or obtain that type of experience. You can usually garner that by 3 months of just learning how to trade and watching price action and studying. When you move below that daily chart and you drop into like a 4-hour chart and then to an hourly chart, it's going to take you around 3 months just to get familiar with that time frame in reference to what it does on the daily, the weekly, and the monthly chart, and how all those things fit together. If you do all of your trades based on the framework, the premise, and the narrative around that time frame. Now, let me very, very specifically say what I just said again in different plainer terms. If every trade that you're trying to take is either going long or going short based on the information that you gathered from the 60-minute, 1-hour chart and higher, you're going to filter out a lot of all the things that you're probably getting beat up by right now. You see me, my students, you see my teachings where I'm using a 1-minute chart. But I'm taking for granted that you've already studied all of the core content, all of the lessons, all the playlists where I'm talking a lot about how I'm really looking at what that weekly chart should be trying to reach for, expanding higher or lower. And I'm not trying to predict the closing price on the weekly chart, but I'm looking predominantly if the market's likely to go higher on the weekly chart, even if it goes up higher to take out a high. I don't know if it's going to continue after it goes there, and I don't really care. If there's a range of opportunity for me to see where it opens on Sunday, or using the opening price at 9:30 on Monday, there's 2 opening prices there, whatever one you want to use. If you want to be highly, highly sensitive to what the market will likely do for the weekly range, then you use the Sunday opening price. And that new week opening gap, if it's there, extend that through all the way till Friday. Those points of data are going to be influential to what the price action is likely to do for that given week. But that's not taking into any account what your experience level is going to refer to for, is this day part of a week that's going to be trending where has a lot of range to trade to for a weekly objective. So in other words, if the weekly chart or the candlestick or range or bar for that weekly range, the highest high and the lowest low of the coming week that you're about to trade in, if it has the potential to move 400 points, or 400 handles rather, then that means that the majority of your focus should be trading in that direction, whether it be higher or lower. So if it's likely to move 400 handles for NASDAQ for that weekly candle, now you don't know, and I don't know, if it's going to literally move those same 400 handles in that one given weekly range. It might go a large portion of it, stop, stall, retrace, and then the following resume and go into that continuation. And that's part of understanding what that monthly range is going to do. So all these things are fractal mindsets and little components, little small little cogs. It's part of the machine that we look at in terms of the price continuum. If it's going to keep reaching for a higher time frame liquidity pool, you want to trade in that mindset. It may not be liquidity. It may have already taken liquidity, and now it's just going to reach for an inefficiency and then resume reaching for an opposing pool of liquidity. And it sounds very complicated, but it's really not. What we're only doing is simply looking for the higher time frame, monthly and weekly, to give us some kind of inclination that the market wants to reach for some obvious stop above or below the marketplace. And if there's any inefficiencies in close proximity, we have to account for that, because it will want to go back into those points. And I'll talk a little bit about inefficiencies and such, and I'll teach you really what I was using the other day when I recorded it. But this can't be emphasized enough that when I'm speaking or I'm showcasing something, many times I don't do a good job of reminding you that I'm referring to something on a weekly or a daily chart, because I beat it to death in all of my talks where I repeat myself over and over again. It's astonishing to see how many people leave comments saying, why are you doing this or why are you doing that? And those are the things I talk most about. And that's why I talk a lot, because I want to be repetitive, so that way you're going to be immersed in it and you're going to be saying what I'm saying right now because you've heard me do it dozens of times in other lectures or teachings. So that way you know it like the back of your hand. And that's how it needs to be. You need to be bored by those details, because if you're bored by them, then you know them. You know them like a book you read 15, 16 times. You know the outcome. The narrative isn't going to change because you just spent 3 months away from that book. Well, price action is the same way. You're going to get these little plot twists every now and then on the lower time frames, but generally on the higher time frames, it's usually the same thing. It's usually always the same thing. It's reaching for a pool of liquidity. It's reaching for some inefficiency above or below the marketplace. And you have to discern. This is the hard part. This is where a lot of experience comes in. Okay. Are we likely to stay in a range? And if we are, you have to avoid trying to get rich on all these moves that you're trying to enter. Okay. One of the things I found interesting watching folks that trade live or they do their live streams and whatnot, it's interesting to see how their expectations change based on the initial movement of their trade. Once they enter the trade, listen to how they talk. And if they show their face, watch their face, because they will wear their emotions or they'll speak it. You'll hear the tone change. They'll be more talkative or they'll get real quiet. That's their emotions being shown to you. Now, they may try to save face and say, well, I'm just trying to focus. No, you're trying to find a way to breathe because you're panicking, because everyone's watching. Everyone's able to see what you're doing. And you know that they're judging everything you're doing, whether if you're making money or not. You could be in a trade that's being profitable at the time. And that many times is a cause and a reason for you to be cautious. And now it has already moved to an objective quicker because you haven't put a limit order in. And you're not using a stop loss because you're not showing that either. But it's moved too fast. And now you're thinking, oh no, this went way faster than I thought it would. Do I hold it and get a really big lion's win and be able to beat my chest in front of everybody and say, look at this. You saw here live. But they didn't really detail all of that. And that's because you're placing too much pressure on yourself. So what I try to do is I try to teach very, very, very simplistic things, looking for a stop run that the market is very likely to run where an old low is and an old high is. That's simple mechanics of market structure. I mean, it goes without saying. If anybody's going to use a stop loss on a long position, they're going to anchor to some recent swing low. And if it's a low that has a very comparable low near it, scrolling back to the left, then they're going to see that as what? They're going to see it as a retail level of support. And it's going to sell the idea even further to them that it should be safe because it tried 2 times to go down there. And what I've tried to do over the years is try to open your mind to that's exactly what it's designed to do. It's designed to coax you into trusting it. You know, when a hunter is hunting, many times they'll put feed out on a trail that's well traveled by deer or whatever they're hunting, because they want them to keep coming back. There's a reason for it. They're baiting it. Well, the market is doing that every single day, every single minute. It's doing that. It's baiting the perception of us, the speculator. And if they keep chumming the waters with things that is collectively and classically referred to as support or resistance, it's always sold as, don't overcomplicate trading. It's simply support and resistance. Well, tell me how you're going to find consistently the support or resistance that works for you 90% of the time. Because if it was like that, everybody would be doing it, because that's the first thing you encounter when you start learning how to trade. It's support and resistance. Don't overcomplicate your trading. Well, the people that say that don't overcomplicate your trading, let them prove that they can go out there in front of you and pick the right support and resistance, and then you'll see nothing. It's crickets then, right? So it's not as simple as that. And I try to be honest and tell everybody, look, if there was a way for me to simply go in and go, here's the right support resistance, here's the right inefficiencies that work all the time, I could have done that in one video. Anybody could do it if they knew that. But there's a lot of parameters that go along with knowing that idea. So you have to look at what that monthly range is doing in relationship to the last 6 to 9 months. What is it doing? It's reaching for something as well. But that weekly range is going to be requiring 4 of them generally to go into the makeup of a monthly candlestick or range. And you have to be willing to trade with that idea that, okay, the trade that you're looking for today is based on something that you think that weekly chart's going to do. That means it may take all the way till Friday for what you expect to see pan out as an objective. Are you willing to take that trade and hold it until Friday if you're trading on Monday? Chances are you don't have the aptitude or the comfort level or experience, patience, and these are not knocks against anyone. It's just these are human characteristics that most traders are opposed to, and they have to wrestle with, and they have to grow into these things. But think about it. Just because you're trading in a 1-minute chart or a 5-minute chart, and you're trying to trade with large range objectives, something based on a weekly chart, you see these relative equal highs, or you see these relative equal lows. And I'm speaking, hypothetically, because I'm not trying to draw anything off the chart here. The idea is, are you willing to submit to the time it may require for that weekly objective to be met if you're trading early as Monday or Tuesday and waiting for that weekly range to expand to that level? If you're honest with yourself, if you're relatively new, you're not. As soon as it starts trading and you're in the move, you're already looking for an excuse to get out of it, because it suffocates you, because you're experiencing the uncertainty that every trader has to embrace. That you have to be able to look at the market and say, okay, I don't know when it's going to start running. I'm still learning that part, so I have to submit to this much time. I put the trade on based on something on the weekly chart. It's going to reach for these relative equal highs or this inefficiency above the marketplace. That's the draw on liquidity I'm looking for. And I just entered the trade. I used a 1-minute chart to get in. It's the right time of day. The market looks like it's already made its low. It's done its initial opening range. It swept some sell stops. So now I'm in on a bullish fair value gap, and I'm trying to trade up into a high that's maybe 250 handles away. That may not be your cup of tea. That may not be your model. But I teach my students to trade with that mindset. You won't have the experience to hold on to that type of move. You're going to want to get out as soon as you get 10 handles, because you have never had 10 handles before. And when you first do it, take the 10 handles. Feel what it feels like to have that win, but still study it like you're in it. Every little fluctuation that would be moving in your favor or against you, you have to really measure what that would feel like if you were really in there still holding that trade, and be honest with yourself. Track the amount of drawdown and the length of time it takes to get to that daily objective, and how long it takes to get to that objective you were aiming for the weekly chart. And it may not get there. And then you'll be thankful that you did take the profit, or split it in half. If you have a way of taking off one portion of it as a partial when you feel that panic, take it off, and then try to reach for the time of day where you should have a consolidation. So if you're trading in the morning, try to at least hold it till 11 o'clock Eastern time, again, New York local time. And that usually will cause some consolidation or a retracement that sets up for that hourly, not hourly, but the lunch hour consolidation or retracement. And then go back in and start studying it from 1 o'clock or 1:30 in the afternoon Eastern time and see if it wants to resume and move in that same direction. These are all gradual approaches to baptizing yourself in the understanding that you're going to glean from watching price action. A book, a course, a video, watching someone do it live, you could literally be over someone's shoulder every single day. That is not going to give you experience. It's going to give you trust in them. But in your mind, because if they do it right and you copycat them, you're associating falsely that you get experience from that. And the only thing you're experiencing is splashover. You're following someone that knows what they're doing at the time and why they're doing it. And it may or may not be the right reasons for why they're doing it, but that's what you're trusting. And to me, I think that's stupid. You're trusting someone else that's not really going to be 100% honest with you always why they're deciding to do that. You don't know if they're mad at their husband or their wife or whatever they're doing in the morning before they start trading. You don't know if they're sick. You don't know if they're pissed off. You don't know if it's the last day they're going to do it and they just want to self-destruct in front of everybody. You don't know any of those things. But you're trusting that they're going to make the right decisions with your money if you copy them. To me, that's stupidity. So you need to adopt the things that you have seen work for you, that you've trusted, things that you've seen that causes concern for you. Now I'll talk about what I saw the other day when I was taking that trade in the NASDAQ. I liked the initial run, but then I saw something I didn't like and I annotated that. But I stuck with the idea because I took the trade based on this premise. So as long as I don't see those things change or undermine the underlying expectation, I'm going to stick to it. Now, as someone that's brand new as a trader, as soon as it runs up there and starts to retrace like that, they're going to close the trade. They're going to get scared. They'll close the trade and be done with it. And then when it does run in their favor, they're mad. And because it does those types of things, they want to go right back in and get revenge and say, you stole an opportunity from me and I'm going to take it back by force. And the only thing you do is pay more commission and you lose now because you're expecting the run that you were expecting to pan out, that did pan out. And then nothing beyond that is what you would expect for that given trading opportunity or that day. Now you're expecting to squeeze the last bit of juice out of that lemon and you're getting nothing but frustration. And that will repeat over and over and over until you step outside of that cycle and say, okay, I have to be here on time. I have to have something in an expectation of why the price should move a specific way. So I said all that, which is a long way around the barn, to cut to the chase with this. Since we are in this large consolidation from over here in the beginning of March all the way through here, it's been just ranging, okay? The highest extreme of the range is here. Okay, so to the left, there hasn't been anything higher than that. So that's our high-end watermark level. There's a lot of liquidity up there. Who's up there with their liquidity resting above that high? Large funds, larger traders that are bears, and they're trying to time some cyclical, some technical, some whatever, gizmo thing that causes them to have some measure of bearishness. And the lowest point of this consolidation is this low right here. So the largest pool of liquidity, the magnetic impacts of price action right now are directly linked to this low and this high. Where are we at in reference to that? If we take a fib, I'm not a Fibonacci trader, but I use it to teach and identify premium and discount. Right now, market price is where? It's near the low of the range. What range? That low and that high. Look how many times we worked in premium. That means premium is the high to the midpoint. It spent a lot of time up in that area. Then left it energetically, came back up just to close this inefficiency in here. But look where the bodies were telling you. Yeah, we'll reach up into that premium side of that range, being the high and the low. The bodies are telling you hey, look, this is all reaching for a short-term premium to sell into because our underlying motive is to run against the long holders. So how would they do that? They're going to attack key levels of support that retail will trust as a barrier or a defense mechanism for their long positions. So what are they going to do? The lion simply goes to the watering hole to drink. And then when it drinks, it goes to the tall grass and lays down. Why? Because it knows everything else it eats needs to drink too. And this is the watering hole right here and right here. So the market has a very high degree of probability of reaching for that low and that low. More specifically, this low because it takes out a larger population of long holders. Yeah, there may be traders that have been long prior to this run up over here that have their stop loss right there. I guarantee you the liquidity that's below that low is far less in volume than the liquidity resting below this low right there. Because larger fund traders or hedge, they will have their positions hedged with a stop loss that's far outside the normal static parameters of intraday fluctuations, meaning that they're going to look for a much more meaningful pull against their trade to decide they're wrong. Why? How can they do that? Because they're not over leveraging. They're not putting everything on the trade. And they're also scaling into their position. So they're not having an entry that's only specifically anchored on one entry price point because they're using such a large degree of equity and capital, they have to scale in their positions. But they do have a core measure of risk that they have to define. And that's what I'm thinking of when I'm looking at price. And that's what I had just described to you. Okay, so if this is a book, say it was a book I was trying to communicate this would have been one chapter. And for some of you that have traded for a while, you already know these types of things. Others that are simply looking for just simply a fair value gap and relative equal highs and lows, you now know that there's something beyond that that's required. And you don't get it by reading another chapter. You get it by watching real price action and studying old price action moves and data. You study what time of these moves begin, when do they conclude. If you're expecting a market to be bullish and the market is uneventful in the morning, even if there is a high impact news driver, if nothing happens, then we don't force it before 11 o'clock in the morning, New York local time. We sit back and say, okay, then the move's coming in the afternoon. You see that paradigm shift that just took place there? If I'm expecting something to happen, where the market needs to likely draw to a level that's obvious, it's obvious that these relative equal lows are in close proximity where price is right now. Does that mean it's 100% a surety that it's going to go there? No. It just means that it's more likely where price is right now, 18,105. It's more likely that it will go below these lows here than it is to go above that high. And why do I say that? Because they're so close to this low, the opening range in itself at 9:30 to 10 o'clock can come down here and do the damage in the business of collecting all that liquidity there. And it's not my interest or concern if it goes to that low and keeps on going down because there's an inefficiency right here on that candle. That's completely outside the scope of interest for me. Why? Because that's not my model. That's not what I need. That's not my cookie cutter. I have to have something that is always the same thing. Back to that cookie cutter shark. The cookie cutter shark is not going out there and doing machine gun strikes on everything that swims by. It's looking for something that's been lumbering or sitting still. It may be sleeping, sitting still. It runs up on it, takes it, and it's gone. And the thing that gets bitten many times doesn't even know what hit it. Well, I understand, just like that cookie cutter shark, that's their mode of feeding. They're not reinventing it. They're not trying some new strategy. Okay, they're not trying to do something different so it can survive. So as a trader, you have to strip this down to, and especially in the beginning, you have to find something that repeats a lot. Well, running on relative equal highs and relative equal lows, or running into an inefficiency like a fair value gap above or below the marketplace, you start by studying that, and you don't have a bias when you begin. You don't have it because you're not going to know it. You'll be spending all this time jumping around on live streamers, listening, and most of them don't even agree. But they could all collectively walk out of that same day having net profit. And that makes it more complicated and more frustrating for you because you don't know what they're thinking while they're trading. And many times they're probably doing something that they didn't intend to do that day, but because of their experience, they changed gears and said, okay, this is what I really wanted to do. And they maybe even outlined it in their live stream. But something changed in the price delivery, the things that they're looking for, and it changed their mind. And there's nothing wrong with that because they're submitting to their experience and they're using their model now in a different direction, and they're receptive to what the market's doing. In the beginning, you don't have that trait. You don't have that characteristic. You don't have that trust mechanism that, you know what, I did expect this to happen, but I understand it doesn't make me stupid. It doesn't make me foolish. It doesn't make me unlearned. It doesn't make me an unprofitable trader. It doesn't make me someone that's guessing when I'm changing my mind. It means that you are being diligent about being flexible. And in the beginning, you got to be careful to guard yourself away from being flexible in the sense that you're going to buy and sell because of the market moving quickly and it lures you in. And because you really don't know what it's trying to do, you think the initial run, the quick suddenness, that's what it's telling me. It's telling me it's going to go up there. Yeah, it's going to run 32 handles, but it's probably still going to run 5 more. So let me do that. When you don't realize or appreciate the level of risk that 32 handles, it may retrace that down half of that. And you're trying to get 5 handles. You're trying to get 10 handles. Are you able to weather 16 to 18 handles drawdown because you chased it? How many times have you been burned doing that? Because you're not anticipating, you're not expecting something, you're not looking for your cookie cutter to be implemented. You're waiting for someone else or something to convince you that this is going to be the one that works and you have nothing to fear. And instead of doing that, the way I teach is I want you to go in and study without risk, without even pushing a demo account. No entries. Just study price action. Do these things tend to repeat? And it's something that's so low threshold in terms of an objective where you can build your entire model around it. And that's that 5 handle you run. That's just to get your toe in the water. That's not to say 5 handles is, that's the promised land and you don't need to do anything else, because you're really many times risking 1-to-1 or sometimes a negative R. And as long as you're learning where you're not risking real money, there's nothing wrong with that. There's nothing wrong with that because you have to have a baseline to build from. And in the beginning, you're not going to know what you're doing because you're going to be chasing price. You're going to just, let me see what happens if I do this. And then you regret it. Even if it is a demo account, you're like, man, I can never get these demo accounts to move in my favor. So you get frustrated and you jump around from one person teaching something, some person doing this, someone's doing live stream, someone's doing a mentorship, someone's selling notes to somebody else's stuff that's already free on their YouTube channel. Hint, hint, nudge, nudge. So there's a lot to this, and people really do a terrible job of being honest out front and say, look, you're going to waste a lot of time. Your first 2 years is going to be a lot of wasted time. And you won't identify it as wasted time because you're going to try to do all kinds of things trying to make it faster for yourself or shortcut things. And all those things are detrimental to your development. But nobody's listening. I tell my students all the same thing all the time. And they hardly ever listen until they finally go through the pain and they come back and say, okay, I'm going to do it the way he said. And all of a sudden, now they get results. I have millionaire students now. Okay. It's documented. It's there. It's real now. Okay. So it's replicable. They can go out and do the things that's taught in these free videos. But it isn't easy. It's easy to do because it's at your own pace. No one's forcing you to do it. And if you have a role-based idea that allows your cookie cutter is your model. And what do I mean by that? A model could be simply as, I think at any given time, if the weekly chart is likely to go up 100 handles, okay? I'm again, just to prove that I can do this every single day. Every single day I can outline a model and they'll all be different and they're all potentially profitable where they don't look and sound like anything else that's said before. But let's just say that you expect that the weekly candlestick has the likelihood, the high probability. Now, when I say that, you're thinking, okay, so what is he hiding and what is he not saying there that causes things to be high probability? Experience. You can't buy that. You can't obtain it by purchasing it. You have to earn it. That means you'll learn over a period of time when the market's running higher, you'll know which one of those fair value gaps is real and which ones are likely to stay open. That's experience. You know, if you sit down with a book that I'm writing and I say, okay, this is what it's, you're going to be like, but I heard him say this and I was hoping he was going to say something different. I'm pre-warning you right now. You don't need to buy any of my books. The only reason why I'm writing books is to put it in format where it's anchored to me. Now, dozens of writers have already anchored it to me with writing their books about me. They've already did that. But they don't have the details that I want to share. But I promise you, these details are not going to be, oh my goodness, now it all makes sense, because it still requires you to be in front of these charts, putting that time in, because there's no shortcut. But a model is your cookie cutter. And then you have to anticipate the minimum threshold. If I can see 50 handles higher or lower based on the weekly candlestick, what it's likely to reach for, that's enough for me. Now, why 50 handles? Why not 100? It can be for you. But 50 handles is easy. You can do that in an intraday run. NASDAQ can easily put down 50 handles in one day and still be a day where it closes where it relatively opens. So it could be an indecisive day. But that 50 handles that's framed on a directional bias that I think that the weekly chart is trying to reach for some kind of a inefficiency above the marketplace or above a high or relative equal highs. It's likely to reach there. Okay, so if I know that it's likely to do that on the weekly chart, large funds, large traders are looking at weekly charts to get in sync with long-term primary trends. They're not going in on a 1 minute chart or sub 1 minute chart. They're not doing that. High frequency trading algorithms are referring to that to cannibalize other traders. So when I say smart money is doing this and smart money is doing that, smart money is not doing sub 1 minute entries. Smart money is accumulating large positions over a period of time, averaging and scaling in, but using that logic, we can still go against them because that's what I've framed here with this large consolidation. The largest pool of liquidity and opportunity rests right below that low because the market has gone up a lot. We're entering the spring. Spring usually has some measure of retracement. Even if it doesn't take that low out here today, it could probably do it on the report that's due out later in the week or before the close of Friday. And what happens if it doesn't do that, ICT? You're wrong. It just means that I have that opportunity and that mindset going into trading next week. See, again, that's a paradigm shift. You're not going to trade with 100% accuracy. And many of you, like I did, I wanted to find the person that was able to do that. And that's a unicorn that doesn't exist. Okay, they don't exist, folks. They do not exist. The faster you accumulate the trust in yourself, being the catalyst for buying and selling or getting into a trade or out of a trade, that's your superpower. And if you can go into a weekly chart and say, okay, I think that it's going to likely run 50 handles higher to that fair value gap that's above where we're at right now. You're doing this on a Saturday or before Sunday's opening bell. You're doing that type of research. That's your study. And you see, okay, it's been moving this direction for a period of time. What period of time? Well, it could have been doing it for the last month or two, last 6 months, a year, whatever. What's it trying to obtain or reach for? right now in close proximity to where we closed the previous week's Friday, when you're looking at the market after the market bell closes on Friday, between Friday's close and Sunday's opening bell, that time is when you're doing your intel. And all you do is look for, in my opinion, I'm looking for 50 handles that it can run higher or lower based on how it closed on Friday. It doesn't demand a 400 handle run for me to take a trade. Now, I might see something that affords me, oh, well, it might go 400 handles if it can take that first 50 out, and how it trades once it does that. That'll give me more insight to say, okay, well, initially my first objective is I'm going to try to trade with that 50 handle run to this premium level or some discount level that makes that 50 handle objective be 50 handles. In other words, say this is where we closed on the previous week and market wasn't live, okay? And we're in close proximity here. Well, if we looked at that right there, that's less than 100 handles. So that's certainly 50 handles, right, to get to that low. So I would start the week expecting whatever this market would be to try to aim for that low here. And if it does, I want to see how it trades to that low, because this low is much more important. You see what I just did there? I took everything I said earlier in the discussion so far today, and I will be looking at live price action, but I got to see how we open and how we work that first 30 minutes, because that's the opening range. I want to see what we do with that. I anticipate, so that way we know what's going on here, I anticipate that they'll want to work towards this low. And if we do, I want to see how energetically, if at all, I may be wrong, how energetically it wants to run below that low to take out this low here. And we just opened now. Okay, so taking that large macro perspective, let me drop down into a 5-minute chart. Okay, so we have all this range in here. So you don't want to take a trade right away out the opening gate when you have all this exposure in here. All of this here, it can easily retrace into that and then roll down to take that liquidity out below that higher time frame trading range. The sell side that's resting right below here, that's, in my mind, where the most probability for where the market will likely go down to. It does not need to go down to it today. It may do it on the other high impact news driver in the week, or after that report and going into Friday's close. So you can see how fast this can be complicated if you're trying to always sit down and say, I need to know every single day, every single session, every single 1-minute candle. I need to know everything about that one right then and there. There are times when you have to sit still. Right now is one of them. We just opened. We have a huge gap. Right now we're looking at electronic trading hours. This is regular trading hours. See that? That's your opening gap. That's your opening range gap. You use this price there, the close, and where we opened. So that would look like this. I wish someone would have done this when I was learning how to trade. They don't even have to push any buttons. All of this makes so much more sense when you remove the necessity of being right about making money or not losing money. When you strip it down to the core essentials of what it is that you're trying to do. Because if you can do that and you do the right things by doing that, the default is you won't lose more money than you make. That means you have an opportunity to be profitable. And then you milk that into opportunities where everything is really aligned in your favor. It's harder for you to be incorrect about certain setups. And you won't know what they are for you until you spend time doing this. And that's why I said your first 2 years is a lot of wasted time. You're going to have doubts. You're going to have it right for yourself. You're going to have your model, but you're going to feel like you need to tinker with it. And then you lose some of the efficacy to it. The efficiency behind that model that's stripped down, it's simple, it doesn't have a lot of moving parts, and you're comfortable doing it. But what happens is you get bored and you want to make more money. You want to make more trades. And that's not the answer to this. This equation is solved by doing the least with the least amount of risk, and then letting time do everything else and the money management do all the heavy lifting. So this opening range, this midpoint here, that's the mid part or point price level of the opening range. I always anticipate that trying to be at least reached. Now, if at any time if we, for instance, I like these levels down here. I think that they're likely draws on liquidity, but we still have to, contend with the likelihood of trading back up to the very minimum of that level right there, because that's the midpoint of the opening range gap, or the gap opening. Okay. There's schools of thought about this in trading where they'll say, okay, trader A, okay, or we'll say trader Steve. Trader Steve likes to take trades where he sees these big gap down. He's not a bias type trader. He just wants to buy the opening when it's a gap like this, because he knows there's a pretty good chance that the gaps tend to get filled, but not always. Okay, so how trader Jane, okay, she sits down. She goes, I like to short when the market trades back up into the gap when I have an objective of where I think the market's going to go. So she's not buying this to make money going up, where Steve is trying to do that. And Steve's not trying to get the entirety of the gap closure. He's looking at old lows like this and like this, because he's a support and resistance trader. So he would look at this and say, well, I like the idea of framing my trade on trading up to that. And that's really good. Why? Because it's still less than half of the gap. Why is that important? Because on really, really bearish days, okay, Steve might not have the aptitude or experience level to know when it's going to trade up to the midpoint of the gap. But he also understands that he may be on a big bearish day and he may be playing with fire, but his model is buy opening gaps. If it's gapping lower, he wants to buy it. That's his model. He's not trying to do anything else. He's not trying to reinvent the wheel. He's not trying to create something new and try to shake up the industry. He's just simply going in there like a cookie cutter shark, going in there, taking his meal and run. So if it goes up to some level before the midpoint and it retraces and runs lower, that indicates what? It's a really bearish day. And that means he would be holding onto a trade, expecting it to be delivering more than it's likely to do. So overstaying his welcome and letting a winning day or winning opportunity turn into a losing. So he's learned to know that he's learned to know. That's not good. He's done it long enough to learn and know that he needs to have objectives to reach for before he gets to that midpoint. Because if it's a really bearish day, it may not even trade to the midpoint. And I like to see those signatures. That's a signature that's real important to me. That's indicative of something that may be a longer term duration. Whereas if we can't get up to the midpoint of that gap, at least to trade to that level, and we start to sell off when we trade below here and go lower, that really shows weakness, underlying weakness. That means we have probably a large degree of probability for even lower prices going into Friday's close. Now, you see how fast all this still compounds in complexity? And it takes time to build this data, to understand that these are the types of things that can tend to occur in price action. So you have to have your model stripped down to the smallest, the least moving parts as possible. And in the beginning, you're inundated, especially from someone like myself, where I have all kinds of things and we can make all kinds of models. But if that model doesn't fit your personality, if it doesn't fit the way you think, the way you tend to look at things, it's going to be impossible for you to use it and make money, because you're going to second guess it. You're going to try to outthink it. You're going to try to outperform it and get in before it should be used as an entry. You're going to get out because you feel something in your stomach that doesn't feel like you should hold on to the trade based on real data. What if you made that decision on? What have you collected in terms of experience that helps you frame that mindset? Versus Steve, the trader here, hypothetically, he's buying an opening gap with the expectation that it's going to trade up to this low here. It could stop just going above this low here like it is here. It could stop right there and not even go to that level there and go lower. And that would be a losing trade for him if he allows it to stop out. He's okay with that because his cookie cutter, his model, is only looking for one specific thing. And if it doesn't pan out, he's not going to arm wrestle it. He's not going to get mad about it and say, oh, my model's broken, I'm going to try to do something else. What is this other guy making a YouTube video about? I'm going to try to do what they do. That's someone that's never going to be consistent, except for consistently system and method hopping. And you don't want to be method hopping from one discipline or one approach over and over and over again, because you're not giving yourself the chance to find something that's going to fit you. And you have to spend time with something, whatever it is, whether it's my stuff or someone else's, to understand where your character flaws are. And you got to be real honest with yourself. Are you impulsive? Are you just trying to get in there because you can't stand to be waiting for something to set up? Are you afraid of risk? Then that means you need to trade with a demo account until you're completely bored to death about the outcome. And you're even with a demo account, you're trading with the smallest margin used for leverage. It's not about the money. It's about you framing the mindset that's required for you to do this. Because until you adopt that mindset of knowing what you're doing and why you're doing it, adding money to it, over leveraging, will change the dynamic, and it will completely introduce fear. Because now that little fluctuation that you would expect as a cookie cutter approach to get in there, it's real easy to get 10 handles a day. That 10 handles, if it's over leveraged, it can run 10 handles like this. And it can be thousands of dollars. And your funded account, your live account, your demo account, whatever, is roasted immediately. So it's not about how fast you can run. It's how can you calm yourself down in the beginning and give yourself the chance to learn how to do this correctly, and removing the outside influence of people telling you, oh, that sucks. Oh, you're never going to be able to do that. Or my thing's better than yours. My widget, my horse shit that I sell that no one really makes money with. Nobody's ever documented it with profitability. All these things that are going to be constantly trying to, pine for your attention. Take yourself out of all that. Get out of social media. Stop having conversations in social media. Don't let other people tell you what you should do. Pick something, whether it's my stuff or someone else's stuff. Stick with it, at least for 6 months. And if you're not willing to submit to 6 months of baseline evaluation on yourself, how do you make your decisions? Are you quick about trying to go in here and do something? Do you change your mind real frequently? Are you indecisive? Or are you really lazy? Or are you requiring a whole lot of things to make your mind up about something? Because all those things, they can be labeled as weaknesses from someone on the outside that does something different. But you'll allow that person's opinion about what you're trying to discover about yourself to frame the direction or the approach that you should trade. And they know nothing about you. They just know whatever you've made available to them. But you live in your skin. You know what it's like to be you. So you have to take a lot of time in the privacy of you studying whatever it is, my stuff or someone else's, and discover what those characteristics are about you. And you got to be honest. You know when you're doing something stupid. It's when you're sitting down with your demo account, your funded account challenge, whatever, and you're pushing the button to find out what happens. Well, you know what happens. FAFO, right? You mess around, you're going to find out. And a lot of times you're discovering that you shouldn't have done that. Now, you don't want to be doing that 6 months later as the catalyst for why you're doing something in the marketplace. You don't want that. You want to know specifically what it is you're looking for and why you're looking for it. The market is likely to draw down here because there's a large pool of liquidity. There's big sell stops down here. Okay. We don't need a whole lot of scientific reasons to justify that. We don't need a retail logic or theory for that. We don't need a Fibonacci for that. We don't need any kind of, PD array. Nothing. It's common sense that that's the lowest point of this range. We're so close to it right now. We've already had a huge drop here. We're not even able to get to this low yet. It could still, but we're watching it. What I would like to see is I want to see price try to at least get to this level and get above it. And if we start rolling lower and take out that low, then it's probably going to be a real fast, easy run on the very first 30-second or 15-second fair value gap that could be sold short and then run that low out right there. That's exactly what I'm thinking right now. That I've told you exactly what I would expect to see if certain factors and certain things panned out. That's based on everything I've said in the discussion here. That's probably bored the socks off of most of you. But for someone that's really trying to learn, they have a ton of notes now. They have a ton of epiphanies. They're like, wow, that makes sense to me. Or I'm in that stage of development, or I went through that. Now it makes sense. It's just 3 decades of experience. I did a lot of things wrong. And I know that human nature being what it is, as much as I would have loved to have someone do what I'm doing right here, which may seem like nothing to some of you because social media has adopted the squirrel attention mentality where teach me in 1 minute or you don't know how to do it. That's I'm not a TikToker, but everybody's developing a TikTok mindset. So you have to have a 30-second or 1 minute approach to show something, and you think you've mastered it. So now you can go out and start selling courses and books and signal services. So I'm not catering to people like that. They're idiots. I'm not trying to cater to someone like that. I'm talking to the individual that wants to really learn how to do this themselves and not rely on having to come back to my YouTube channel or anyone else's YouTube channel. See, that's what separates how I teach. I want you to know how to do it so that way you don't need to go into anything that I do in the future, which I don't want to do much at all. Like I told you, I'm trying to be done with all this stuff. You will be comfortable in your own skin. You won't feel any tendency. You won't wake up and say, I'm going to look at the charts and I don't see something. So let me see what everybody else is doing. No, 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 no. I know what I'm looking for. And what I do is I go onto YouTube or I look at social media and the regular haunts that I go to, and I try to see what they and their crowd wants to do. And if I have something that is opposed to what they're trying to do, I feel confident, and it sounds arrogant, but I feel confident that what I'm expecting is more likely to pan out because the hive mentality or the herd mentality, rather, of retail, generally, not always, but generally, they have it wrong. Sometimes they're in agreement. I might be bullish, and if I go in and I listen to what their chat rooms are saying or what they post about something, and then read the comments behind it, and everybody's like, yeah, I believe that too. Oh yeah, I'm with you, boss. That's what I'm doing, champ. Whatever it is, I like to look for those things because what they're doing is they're emotionally co-signing. They may not have a real account. They may not even have a demo account they're going to push. But the fact that they're subscribing to that view is enough of a sentiment indicator for me to feel very comfortable with what I'm trying to do that was already predetermined and opposed to what they're doing. So I'm comfortable in my skin. I'm comfortable looking for that. So I'm looking like a lion. I'm in the tall grass right now. In the next 15 minutes, I'm still waiting. I'm waiting for that gazelle. I'm waiting for that, unknowing animal that just wants to go down to that water hole and get a drink and their lunch, their dinner. They're feeding my cubs. Okay, they're filling my belly with meat. It's nothing personal. I don't dislike or have animosity towards them, but they're food. And as a trader, you have to strip it down like that. You got to make it simply plain, just as simple as that. Someone's losing money when you make it. It's a net sum zero game. So you have to come to terms with that. I don't think there's anything unchristian about that. Everything's an investment. So when we are looking at price, if we have something where we can frame it on that weekly chart that allows for at least 50 handles, then I have a lot of opportunity and multiple time frames that I can frame that on. And it'll be very easy for me to do it in a sub 1 minute chart. So I'm just going to drop down into a 1 minute chart here. Give me 1 second. I got to tell you, man, we just lost my wife's mother. She just passed away finally. We buried her last Friday, and the last couple months have been really rough. And my wife's tore up about it, and she's not here. She's spending time with her father. But I've been wanting to do this to distract myself, but I've not been able to. Obviously, I've been able to, only do what's necessary as a husband for my wife and whatnot. But so see what I'm saying? We didn't get to this high. I'm sorry, we didn't get to this low here. We could just get right above that and then stop and go lower. So now that we've done this, we can look at lower time frames. We're in a 5 minute chart now. I'm not going to go sub 1 minute. We'll go 1 minute. So everything we watch in here, we'll see if it pans out and reaches for a fair value gap. Now we have two potential. Now, if I don't want to see that one close, I was going to say, if we can keep this one open here, I would treat that as a breakaway, but we're real close to filling that one in. So we'll have to watch and see what it does here. But again, my mindset is we want to see, does it have the willingness to get to halfway? Prior to halfway, we look to the left, and where are the old lows at? Not highs, old lows. If it can't get to that level here, which we see it didn't do, what does that indicate? What is it telling you? It's weak. It's really, really weak. So if it's weak, what would it be reaching for if it's going to go lower? Well, this level here, which is those relative equal lows, here. I'm on regular trading hours. Let me go back to electronic trading hours. Sorry. That's these lows here. Whoops. Let me go to 5-minute chart. Pull them up. That's these lows here. And that's that larger trading range I was referring to for the majority of the discussion when we opened it up. That's where the big pool of liquidity is. And this is the near-term sell-side liquidity. Okay, so that's where we're at in terms of the draw. We'll go back down to 1 minute. Also notice what we're doing now. See what we're bumping up on the bottom of? See that shaded area here? What did I show you that was? When we were in regular trading hours, I showed you where we stopped trading on the previous session and where we opened up at 9:30. So that's the opening range gap. The gap was lower. So my focus is I want to see how we trade the first 30 minutes, and we're still inside of that. We have 9 minutes, a little bit like 9.5 minutes still of the opening range. My interest is this level here, and then how we trade below that low. Now look what they left here. They left relative equal lows, and this is the larger pool of liquidity where sell stops are. Okay. That's your expectation, that's your target, that's your objective, that's the draw on liquidity. So you want to see how price is going to frame a setup to get down there. So we have an opening range. We worked inside the opening range a little bit, failed to get up to that old low. So we're going to take that off. That's what that level was. We want to see if it can get up there. Remember Steve, the trader, hypothetical, his model would be to trade to that level. He might have a model here that doesn't pan out as a winning trade. It would be okay. Other Jane, or whatever her name was, she's trying to trade a short. So she wants to see something to get into this opening range to go short. She wants to see it go up there. It did it here. Now we have a fair value gap right here. That was the other one I was going to comment on, but I looked at this one here earlier. I said it might not leave that one open, and I was going to use this as a breakaway gap. This, we want to watch and see, does it behave and support the idea that this was a short-term premium objective just to trade up into and then roll over to attack the sell side down here. And you'd be looking at how we went into the opening range, but if it's underlyingly weak as a market for that given day, like today, does it have the willingness to stay below midpoint of the gap, which is that level right there? Now, a trade setup like this, you would not want to use large leverage. Not that you really want to use large leverage anytime really, but you want to use the smallest leverage on this type of setup. Now, why? Because you still have time. We're still inside of the opening range. So there's times when I do enter the first 30 minutes of the trading day between 9:30 and 10 o'clock. And it's instances like this, but if it would be like this here, my risk is the midpoint of the gap. Think about that. It's not just this high here, because if it does run up outside this fair value gap, it's not going to go just to this high. It's most likely going to run for the midpoint of the gap. That's algorithmic. There's nothing to frame that on in here except for the measurement of where we stopped trading the previous day and where we opened at 9:30. Let me show you in regular trading hours again. Where we stopped trading, that opening price here, I'm sorry, the closing price here, and where we opened today. See that right there? That's what this is being framed on. Those two, let me put it on the very specific closing price. Okay, so it's this to that first candle at 9:30, whatever that opening price is, that's your opening range gap. And because it's gapped lower, it's a gap that can be traded up into to look for shorts if you're bearish. You can scalp it and trade up into it if it's your model to do so. It's a matter of what you feel comfortable doing. There's plenty of ways of trading this. Another setup would be wait till it trades to the half point and then go short, especially if it can spike up but not close at that low. So in other words, if it trades up here, hits that, spikes to it and moves away from it, then the next candle, if it breaks lower, look for the very first fair value gap. to sell short on. And your risk would be whatever the highest high would be after sweeping the midpoint. Whatever you have the experience in trusting, that's the one you work with. I like the idea of still using this fair value gap here, even though we've painted just outside of it a little bit. This is too much of a draw for me to discount it. Like I don't want to. I shouldn't say discount because you're probably thinking something else when I say that word. I don't want to ignore how close we are to this level here and get caught up in all the semantics about this high being the next run to. But if you're taking any trade short, anything below the midpoint of the gap, your risk is to the midpoint of the gap. Always. It's a constant. It never changes. It never an instance where it's going to be something else. So in other words, if you're taking the trade, it's not like you would take a trade here in the fair value gap and your stop loss will be here just above it. That's not correct. You would have to allow for a stop that goes to the midpoint of the gap. Why would you want to do something like that? Well, look to the left. It's that old low we didn't trade to. It might just run up to that level there and still fall short of the fair, not the fair value gap, but the midpoint of the gap. So that amount of risk, that's not wise to go out and trade. Well, my funded account says I can trade 15 contracts. So no, no. And if it requires you to trade with 1 micro, then that's what you trade, or you don't take the trade. It's simple. You can't argue with the risk management rules. You don't do that. The people that argue with the risk management rules or try to stretch it out because they want the maximum effect for the profit side, they lose sight of the maximum exposure to risk. And when they get bitten with that half of the equation, it causes damage. And that damage is persistent in the future. It'll always, you're not going to go into your next trade and say, I made a lot of money on the last 3 trades. I'm winning. If you had a losing trade and the last 50 trades were winners, you're going to have trepidation because you just took a loss. That's scar tissue. So you have to be mindful of that. And that's a real big problem in trading because you can get yourself all psyched up to do something. But once you push that button, all the control is gone. You can only stay in the trade as long as your stop loss or your equity, if you don't use a stop loss, allows for it, or you bail out of it. There's no control at that point. And that's you embracing the uncertainty of your decision. What's the outcome of that decision? You don't know what it's going to do. So you have to have a whole lot of things in your favor in your analysis, what you expect, what you anticipate, what are problem areas, what are things that's going to be detrimental to you being confident while you're in the trade. All those factors, they need to be sorted out beforehand. If it trades to this level, but not to my stop loss, it's still okay. I'll hold the trade if it does that. But if it does something else beyond that, then I'm going to either take half the trade off or I'll collapse the trade and just call it a scratch, and whatever the costs were, I'll eat that. You have to be content with that. And so little is spoken of about those types of things, and it's necessary. It's required. Like, you want to know these things going in. You don't want to discover what it feels like to experience it and not be forewarned about these are the things that the guys that I learned from didn't teach me. And I went through that. And it causes a great deal of growing pains. Whereas if you expect it going forward, someone tells you, hey, look, we're going to go to the gym. We're going to do this workout routine because, I've been doing it for 15 years and look at the physique. I'm going to have you do the same thing and you're going to eat the same way. And there it is. But if they don't sit down and say, look, you're going to be sore as hell tomorrow and the day after, especially if it's leg day, you're not going to want to do anything. And you're going to look for an excuse to not work out that day. You got a headache. You got to take, your kids somewhere else that day. Your spouse says you got to do something else somewhere else. You're going to make a perfect excuse for you not to do it. Whereas if you say, look, you're going to be sore for the first month, it's going to be a lot of adjustment. But if you take sugar out of your diet, okay, and you eat well, you'll recuperate faster, and it'll just be a normal, like I had a hard workout day, and that's it. But in the first month, it's going to suck. You're going to want to quit. Just grind through that, and you'll be fine. That's a better expectation. You're preparing and you're priming your expectations for, this is going to suck for a little while, but I know this is normal. Whereas if you go into trading, you don't know what to expect, and you think you're just going to make money because you're pushing buttons. is a video game, you discover that it's a whole lot harder. And because human beings are classically not comfortable with anything that are causing adversities, whether it be painful or emotional or psychological or all three, because that's all three are checked off when you're trading, you're going to look for the exit ramp immediately. If your first trade is a losing trade, whether it's a demo, whether it's a funded account challenge, or if you have a funded account, or if you have a live account, your first losing trade, you're baptized in all of the things that every trader has embraced. Every profitable, long-term, consistently trader that's profitable, they have embraced that uncertainty. They know what it feels like, and it doesn't kill them. Where in the beginning, when you've never experienced that before, it feels like you are doomed to failure forever and you're never going to be able to do it. And so many people fall victim to that, and they give up well before they even figure out what it is that they should be doing themselves. All right, we got 1 minute left. The opening range will be done, so I'm going to see what we do from here. Now, the trader I was telling you about earlier, the lady trader, hypothetically, her model might be, waiting for a high to come in, then trade above that high. That would be, say, for instance, her model's turtle soup. She could be selling short above this high, and then her risk would be whatever her entry would be. Let's say she's a little nervous, or she's listening to me today and she didn't take her entry and she's regretting it, and she just wants to get in right now. Where would her stop be? Would it be here at this high? About this old low, would it be there? No. Her stop loss has to be the mid gap. So how much can she risk? Whatever her account affords her for. It could, she's risking 1/4%. Yes, 1/4%, not 4%, not 2%, because every book talks about it. 1/4%. Why so low, ICT? Why are you saying such low risk? I'm trying to make money. No, you're trying to keep your money. Everybody's in a hurry to try to make money, and they have lost sight of keeping money. Capital One, preservation capital of the tongue twister. Preservation of capital is rule number 1. That's the part where if it was a recorded version, it would have been edited out, and you would have never known it was there. But rule 1 is to preserve the capital you have. That means keep the money you have. Don't lose money just because you want to take trades. You have to take trades that allow for the highest measure of probability in your favor that you can glean from the analysis concepts that you employ. Those things have to be stacked up in your favor. And if you don't have a lot of them that make you feel confident, and you can't see that trade doing anything but that, in other words, reaching for your objective, if you can frame the trade, the other side of the trade, that means you're not in high probability. High probability is defined by only being able to define the trade in one direction until that objective is met. Then everything becomes gray again. Okay? So if Jane was a turtle soup type trader and she was looking to see the market trade up into the opening range and then fail and move lower, her entry mechanism could be turtle soup. It could be selling above this high, and her stop cannot be that high. Oh, it would be if it was mine. Not me. It wouldn't be me. Because the characteristic of a gap this large is it tends, not always, but it tends to do more of trading to the midpoint of the gap than it does for it not to do that. In plainer terms, if you're trying to sell short on a lower gap opening, always allow for and afford a move back to the midpoint of the gap. That's the plainest and simplest way I can say it. And that means it might not be a day that you can take a trade on because the risk is too large. Is there something wrong with that? Some of you, especially people on TikTok and Instagram and Twitter, oh, that's stupid. Oh, that's stupid. Okay, come out here and do it. Do it. You won't do that, but you'll be opinionated and you'll try to distract other people that are trying to learn how to do it or develop, because misery loves company. So you have to be very guarded with allowing people into your development. The period of time when you're trying to find yourself as a trader, you got to really filter out all the bullshit, because there's a lot of people out there that are going to tell you stuff that have no bearing on what you as a trader are going to do. When you reach your model, when you reach your approach that you feel comfortable in, you want to be able to say that you define that model based on your own exposure, the study, and the things that you saw personally. You're not taking somebody else's word for it. You're not listening to me. You're not taking my word for it. I can only guide you to where to study. And then if these things resonate with you, whatever PD array, whatever specific model resonates with you, that's the one you start with. It does not mean that's the model that you're going to have 5 years from now and you're consistently profitable. It means you may have a variant of that. But you have to have something to give you a baseline evaluation on what it is that makes you tick. How do you think? What are your impulses? What are your weaknesses in terms of responding to information that's being presented to you real time when you're watching price action? If you're not aware of how you're going to react when price does specific things, it doesn't matter whose model or what approach you're using. You're going to be at the mercy of your emotions while you're doing whatever it is you're doing. And there's nothing worse than making money and being scared shitless while it's happening. It's a terrifying feeling. Even when you're having the biggest profitable day, if you're honest with yourself, okay, and some of you are smiling thinking, I've been there. I don't know how that happened, and I was scared to death, and I didn't know what to do. I was paralyzed. Like I didn't have a limit order in, and the market went way beyond where I thought it was going to go, but I was terrified. I didn't know what to do. You don't ever want to be in a situation like that. And you certainly don't want to be in a situation like that when you're on the losing side of it, because that's where accounts get blown. You start looking for an argument in price. No, this is probably going to be the last time it makes that low and it's going to go up. And you argue with it. And then it takes that low out. Okay, well, it was just going to take that one out. And, it can't go any lower because it's been going down for 3.5 hours. And we still have time to do this and do that. And there's some squiggly line, or ICT said something in a video, some obscure lesson somewhere. I'm going to hang all my hopes and prayers on that thing panning out right here, when that's not even in the price action. But you're going to find any excuse to just do rule number 1, capital preservation. You have to have money to do this. If you don't have equity, you don't have a trade. And if you can't trade, you can't profit, right? So you have to do everything you can to remove the likelihood or the tendency for human nature to show itself, which means to act out of emotional response or a psychological response to adversity. And you don't know what adversity feels like until you put a real trade on. When you have real money at risk, I don't care if it's the smallest amount of money, your concern about the outcome is greatly magnified beyond the scope of reasonable. If you went outside and you lost $50, it sucks. Somebody found $50, whatever. Good luck to you. But if you get into a trade and you're risking $50 and it's floating at $45 before it hits that $50 stop loss, you're going to have anxiety. Not because that $50 breaks you and you can't pay your bills. Not because you had a losing trade, but because you don't want to have that notch against you that you were wrong. You've equated being right or wrong being more valuable or more impactful, detrimental to you as a trader than agreeing with the fact that you limited your risk to $50 and you're thankful that when you do get stopped out, it didn't take more than that. Not enough is said or taught about that. But these are major barriers to what causes people to not be able to be consistently profitable or ever profitable, or find a model that they're comfortable with. And that's what complicates this industry and what we do, because the human element that you bring to it, your characteristics as a human, your character flaws and your strengths are all going to impact, both good and bad, mostly bad, your growing phase of being a trader. And everybody wants it to be short and sweet. Real direct. 1, 2, give me a 1-minute trainer, a 5-minute trainer, get to the point ICT. The point is you're going to have to work your ass off. And you're going to discover, whether you learn it from me or someone else's discipline how to trade, if they can make money and they can do it properly and they have proof that they've trained other people and they're able to do it on their own and they're profitable, that's someone that you can listen to. They don't have to use PD arrays. They don't have to use fair value gaps and order blocks. If they have something that works and they've trained other people and they have proven that they have taught that mindset, that skill set, these concepts, and it's applicable in their own hands, not requiring them to tell them what to do with it, that's someone that you can listen to. Spend time with them. And you're still going to encounter all these adversities because you are bringing it to the table. These other educators, these other disciplines of trading, they're not the reason why you're not making money. You are. Just like my students that don't make money with the things that I teach. It's their problem. It's their shortcoming. It's their excuse. They're the problem. Every single one of us have to own that. And in this industry, at a time that we're in it, social media has cultivated the victim mentality. Oh, I'm a victim. No, you're not. You're a lazy ass shithead, and you need to learn how to do this the right way. And own it. If you make a mistake, own it. If you get out there and you do something and you make a mistake, own it. Learn from it. Because every single trade, you're learning something about yourself. You're not learning about trading. You're not learning about the market. You're learning about you. Because your model should be static. It should not have moving parts. It should stay exactly how you designed it. And when you started implementing it, it stays like that. You don't change it. If you tinker around with it, then your baseline foundation of results, you can't trust that. If you're always constantly changing and morphing what it is you're trying to do, how could you trust the outcome and the results that you're getting? That they could be reasonable to expect in the future to be similar in any vein to what you've done with it in the past. If you're constantly changing it, you're moving all the components that caused those previous results. So you can't trust the results to be the same. So you have to have something that's simple, very few moving parts. It doesn't require a whole lot of acrobatics to do it. And you have to be comfortable when it isn't telling you to do something. And that is very hard because everybody wants to keep up with everybody else on social media. And social media is a bunch of liars. There's a bunch of liars out there, okay? And they'll say this, they'll say that. And where's the fruits of it? Where's it at? So if the stuff works, you'll see it work in your own hands. That's the testimony that you have someone that you have chosen correctly as a starting point. It doesn't mean you'll stay with that discipline or that model, but you have to learn a lot about yourself. And why is that important? Because when you understand how you derail yourself, when you find a point where these are things I tend to make repeatedly, and I don't like the way I feel when I do it, and I don't get the results that I like when I do it. So what would you do differently? When you start feeling that impulse to act out that way, or think that way, or trade that way, you don't do it. You sit still and you watch and see what would have happened if you did that. What does that do? Number one, it builds accountability in yourself. It builds self-discipline, which is absolutely crucial for this. Otherwise, you'll get out there and blow $40,000 without using a stop loss. This whole business of wrestling yourself, bringing yourself into submission to a rule-based idea is absolutely paramount. Because unless you control your impulses, unless you control your tendencies to act out of the model, you're not going to stick to the model. And you can't credit that model for being profitable or unprofitable if you do that. So what are you really doing? You're gambling and you're guessing. And when it wins, you're going to say you have a winning model. And when it loses, you're going to say that model sucks. When neither of those statements are true. Think about what I just said there, because most of you are doing that right now and have been doing it for years probably, expecting something different to happen. When it's you are the constant, you're the constant derailment. You're the person that's driving this car right into every tree that comes up. Boom, there's a tree. I'm going to run right into that. I don't know why I ran off the road. Oh, I lost control of the vehicle. No, you didn't. You steered right into it. You aimed right at it, just like that cargo ship did in Baltimore. Hello. I had to wait a little while before we started talking about that kind of stuff. They look for that stuff in the beginning of the videos. But listen, there's a time to take a trade. There's a time to sit still. There are times where you would have to wait for more information. Now, we've had the first 30 minutes is behind us. We've only taken one run of any importance here with this high right there. We're consolidating. I still like the idea that we move lower, but it has to show some major displacement here. And it needs to go below that low before it happens, or before I would feel like it's inclined to trade to that sell side. I would not want to sell it short here. I would not want to do that. I would not want to buy this. Okay. I don't care if it rages and goes and fills the gap. That would be a trade I wouldn't be a part of participating in. I just wouldn't be participating in that trade. There are trades that jump out that aren't in my expectation, and I can't participate in. As a younger man, it used to make me angry, and I would go back and beat myself up and say, why didn't I see that then? And that's a problem. That is a barrier to your development, and it was to mine when I did those types of things. And that's why I tell my students, when you're journaling, you sweet talk yourself. You're your best friend. You're your comforting counselor, like you were in school and you had a problem, whatever. I went through a lot of counseling in school. It was very hard for me to wrestle my emotions. Broken family, all kinds of stuff, and going through puberty, all these things as a kid. No one sat me down and said I was going to experience all this stuff, and then I felt like I wanted to act out violently. So talking to yourself like you're a counselor, you know yourself. You know what you want to hear. You know how to console yourself, but you also know how to rev yourself up. Just think about what that last girlfriend did to you. Look at what that guy did at work and got the promotion, and what you did in response to the boss's expectations. They got the promotion, but you did more work and you weren't identified. It's real easy for you to get stirred up. Think about that person that made a comment on your Twitter post. Think about that person that talks about your trading results, even though you're making money, but they're talking nonsense, but they bring nothing to the table to show a contrarian opinion. But it's easy to get revved up. So in your journal, you only sweet talk yourself. And when you have an opportunity to encourage yourself to do something different or address something that's problematic, to say, I appreciate this day because it gives me the opportunity to identify a very specific thing that I need to correct in my learning, versus, man, I screwed up and I lost the day. I'm never going to get this. This is bullshit. Your journal is not a place to complain about yourself. As soon as you put thought to it, number one, you've already anchored it to your subconscious. If you write it out, you've recorded it outwardly. You made a decision to record it outside of your thought. You've recorded it. So you anchored it now, not only psychologically, but now it's emotionally anchored. So what if you made reference to that your subconscious is going to revert back to when you take the next trade? That emotional stimuli that you've placed on something that you can't change or go back and redo. You have no idea the compounding influence that has on a negative perspective. And you have to constantly reassure yourself that what you're doing is a growth process, and you encourage yourself along the way. And anything that was adverse, something that was hardship for the day or the opportunity or something didn't pan out, you need to teach yourself how to see the example of learning from that without pain. And you always record the fact that you say, I'm thankful, or I appreciate, or I'm so happy that I had the opportunity to learn this without having any monetary loss. I don't feel physical pain from this, but I can take from this experience the ability to see how if I don't identify these consistently, this could be detrimental to me and cause drawdown. And I'm glad that I had the opportunity not to experience that today. So what you've done is, yeah, you identified you did something wrong or you didn't observe something, but you're not beating yourself up. Like if you take it to social media, no one's going to encourage you on social media because nobody on social media wants you to do better than them. It's just like your friends and family. And it sounds ugly, But that's what we are as humans. We're ugly little creatures that don't like to see other people do well. But I want to see you do well. I do want to see that. Many times, my interest in your success is more than yours. And my profitable students all had that mindset that they had to come up to my level of expectation of themselves because their expectation was too low. Their energy level was too low. Their study and time that they were wanting to put forth into this wasn't enough. And they were expecting immediate gratification, immediate results, or it's all bullshit. And it's not like that at all. Like anything, it's going to take effort and it's going to take time. But you're trying to learn the hardest thing in the world, which is master yourself with a monetary reward or punishment. Man, you can't get anything more complex than that. The only thing that's more complex than that is taking a one bullet, put it in a revolver, spin it around, and put it to your temple and click it. That's the only thing that outdoes this in terms of measuring the absolute pain and outcome, because that's what you're doing. You're playing that game here, Russian roulette, with your money, one trade at a time. Because that one trade, while initially you might have a stop loss that has an X amount of money that's a percentage of your equity in total, if you don't get the response that you wanted, the end, you're going to spin the revolver cylinder again and click it again until you blow your brains out and your account's gone. You won't go into that trading day wanting that to happen. No one ever really wants to go, today's the day I want to blow my account. That's not how that works. But it always, after the fact, when you're sitting there in torment, like, I could have stopped. I told myself, don't take another trade. But you were pissed off and you need an outcome. And many of you need a hard stop where you're completely removed from it because you can't control yourself. And that's what blowing your account does. And subconsciously, that's what you want. Because what you're saying subconsciously is, I can't control myself. Please let me lose the money so that way I ain't got to do this anymore. And for some of you, that just hit a nerve. When I was 20, I felt that multiple times. I wanted to feel like I couldn't do it at all. So therefore, I don't have to do any more effort to try to make it work. It gives me the perfect excuse why I don't have to try anymore. But I tried. And I saved up money. And I delivered pizza. And I delivered subs. And I did dumb stuff to get money. To get it all raised up again. And I funded another account. And try. But subconsciously, I wasn't equipped. No one was encouraging me. No one was encouraging me while I first started. It didn't happen like that. And I tried to be practical, but yet firm with you as a listener, as a constant reader, as a student, that these are the realities of this. And the expectation you have in yourself as a trader, or the market's yielding itself to you, it doesn't work like that. It doesn't owe you a payout simply because you spent time in front of these charts. We're not worshiping at an altar of the price action God that says, you worshiped me enough and paid enough alms to me, so now I'm going to bestow upon you bountiful blessings in terms of monetary reward. It doesn't work like that. It's war. It's war. It's internal and it's external. You're competing with the most ruthless people on the planet. And now more than ever, it's never been this corrupt. It's never been this in your face. In your face. F you. I'm going to do whatever I can to hurt and victimize everyone else because they can. So it's very complex, but it's the easiest thing you'll ever do. It's the easiest thing you'll ever do. Push a button. If you're right, you make money. There's a whole lot of stuff that goes on before that pressing of that button. And there's a whole lot of other factors that happen once you press that button. It's the hardest easy money you'll ever make. So the only combat tactic that you can employ is you have the ability, okay? You have the ability to limit how much barring some kind of, geopolitical or wartime event where obviously the market could just go and it's 500 points away from where it's at right now. Drop a nuclear bomb somewhere and watch how fast this market will forget all about daily limits. It'll be completely outside of the normal. Okay. And you're about to see that, by the way, just letting you know that. And if you can control, barring that example there, you have control of that. You have control of how often and how much you're willing to risk on any given transaction or trade. And how does your mind think right now at the time of this discussion that we're having here, or me lecturing really because you're not talking to me? How much are you computing and calculating when you're trying to take a trade right now? What is it based on? How much you can make or how much you can keep yourself from losing? We already know. We already know that you're not thinking about how much I can prevent the maximum of loss and what's the least I can lose and still find profitability. See, nobody's doing that. Nobody's doing that. They're all saying, okay, I have X amount of money in my account, so therefore I can afford to trade this much leverage because this is what I can afford. And if I can, that means if I'm right, I can make as much as I possibly can based on the maximum leverage that the trade can be used to be applied to that individual setup. And that's wrong. Every single time as a young man, I blew an account, I did those same things. And they were the constant things I was doing, always. And the second thing that you're in control of, but you lose sight of this, how frequently and when you take the next trade. It's imperative you understand that when I was journaling, when I first started journaling, it were all negative. Like I was beating myself up constantly. And that's one of the things I grew most from is not being toxic in my self-evaluation. So I removed all that stuff. And when I learned how to manage anxiety, and I had agoraphobia when I was a younger man, one of the coping skills that you use to overcome that is, well, first it was Jesus Christ that helped me get rid of that. But the physical things that I had to do to help cope was doing simple things of trying not to think negative and speaking negative. And Lucinda Bassett, who was the lady I bought the books from, if you have any sense of anxiety while you're trading, or unrealistic fear or generalized anxiety, I would recommend any of her books. She lived with the same thing that I was going through, but it's self-inflicted. Like no one wakes up or is born with this stuff. You learn to be anxious. You learn to be a toxic thinker. You learn that. It doesn't happen overnight. We do it all the time. And one of the things that she said in her book was count how many times you think of something negative in a day. As soon as you think of something negative, put a little check mark, on a piece of paper or something to that effect. And the average person thinks negative thoughts about themselves or something that they're going to be involved in over 300 times a day. And then you look at what the media does. What's the news tell you? Nothing good. It's always bad, bad, bad. This is dying. Someone's died. Someone's murdered. Someone stole something. Someone blew up. Somebody's bridge and somebody's state got this, knocked off, and now it's there. People died. They're never telling you, hey, you know what? You're all doing a good job in this area. Well, why won't they do that? Because the negative sells, and they want to sell advertising time. So if I'm trying to do something which is very difficult, and I apologize if you hear my landscapers outside, they just arrived, but I'm going to keep talking because I feel good about doing this. I've been bottled up, man. It's been months. I had to get this off my chest. I've been so many times been wanting to talk about some stuff, but when we think about these negative thoughts and we put it in our journal, we're making mountains out of molehills. And when we stop doing those things and we identify the fact that, okay, yeah, I'm human. You're human. You're going to make mistakes, but you have to find a way to encourage. Like for instance, if you have a child, When your child is first learning how to ride a bike, okay, everybody wants their child to get on the bike and pedal and just know how to do it right away. Okay. Deadbeat dads, they want to just be able to get out there for maybe 5 minutes and hold the seat, and then they ain't got to worry about it no more. I was emotionally and psychologically invested in making sure my kids knew how to do this. I prepared them. I told them, I said, look, it's going to be scary. Okay. You're going to be pedaling and you're going to be thinking about how it's going to hurt if you fall down. But I want you to identify the fact that even when you do learn how to ride a bike, dads broke bones trying to jump over tires, and ramps and stuff, because you are not just happy with riding the bike. Like in anything in life, you say, okay, well, I've done this, and let me expand my reach. So it's not enough to be enjoying the safety of riding the bike responsibly. Now we have to jump 3 tractor trailer tires and light the tires on fire and do so with a t-shirt doused in gasoline and try not to get burned. That's the stupid stuff we did in Middle River. It was stupid. And I ended up breaking a finger and chipping a bone in my wrist. Okay. So even though I knew how to ride a bike, I was doing things that were not sane. Okay. Like the rest of the kids in the neighborhood, we did daredevil stuff. So I told them, as long as you understand that what you're trying to do and you ride responsibly and you wear your helmet and your knee pads and your gloves, if you fall down, you might hurt yourself a little bit. But even when you do learn how to ride the bike well, you still have the risk of that happening. So that's never going to go away. Do you still want to ride the bike? Yes, Dad. Okay, good. Then when you're riding the bike, I'm going to be holding the seat for you. But then you lie. You're going to lie to your child. I got you, son. I got you, daughter. You're not holding it. Your hand's there, pantomiming. Why? Because you're giving them the chance to trust what they're doing works. And when you're journaling, you're doing that same thing. That self-talk is lying to yourself. You're lying to yourself that you are not feeling pain that day because you did something wrong or you didn't do something right. That's 2 different things, by the way. It sounds like the same thing, but it's not. And when you journal, you'll discover what that is. But you're sweet talking yourself constantly. You're encouraging yourself. You're counseling yourself. It's okay. Everybody has hardships. Everybody's going to lose money. Everyone's going to miss opportunities. It's going to be harder than you thought it was going to be. It's going to take you longer to get there. But you constantly feed yourself positive self-talk. Say, hey, I'm going to do this. Come hell or high water, unless I'm not breathing and I'm not here in this plane of existence, then I'm not going to stop doing this because I want to do this. Because I want to do it. Not because I want to make money, because that's not enough of a driving force to do this. I promise you that if you just want to make money, that's not going to be the thing that keeps you in this. Because if it was, why do all these folks out there that never make money still keep trying to do it? It's something beyond the money. And if they just apply the right approaches to learning and they manage their emotions and the psychology around learning how to do this and manage their expectations and make it realistic, they have a far better chance of enjoying the process of learning. And when they arrive, it won't be like, man, this was so hard to get here. Because they'll be much more well-rounded as a person, as a trader. And understanding those dynamics going into this is really important. And I spend a lot of time in all my lectures talking about it. And until the students that try to use my concepts try to do it without that mindset going into it, and then they suffer because they don't know what they're doing or even how to handle themselves when they had this one adverse result, one result that was not in the direction or in the manner they expected, or in other words, it was not a positive return because they impulsively did something. 99% of the times when I had a student say, I tried this and it didn't work. Okay, show me your trade. What did you do? What was your pre-market analysis? What was you expecting? None of them, most of the time, had a pre-market expectation. They were just reacting. They saw the first fair value gap, or they saw the first relative equal lows or highs, and they think, well, they're on the chart, so therefore it has to go there. No. Go back to what I was saying, that cookie cutter. That cookie cutter is your model. How does it start? You have to be on a higher time frame chart, weekly chart. That weekly chart that's going to pan out this week or the week that's to come, if you're looking at a market for the weekend, like it's not trading during Friday night into all the way to Sunday morning. Sunday, we have the markets open up later in the afternoon or evening. But during that dead time, when there is no market activity, you have to know what you're trying to do, what you're aiming for, Otherwise, you're like a boat without a rudder. Wherever the wind's going to carry you in the current, oh, this is where it got me. You don't want to have that mindset as a trader. You want to know what you're aiming for and only use your model as your rudder to navigate that same current and those same winds that are going to be blowing with everybody else out there in the marketplace. You're going to navigate it the way your model requires you to do so. And if you can't get to that destination because the current or the winds of the market say, no, you're not getting this way, you're not going to get here today, then you're content with, okay, I'm done. I'm not going to go out there and wreck my boat. I'm not going to sink my boat trying to force something that can't happen that day because the currents are not going to allow for it. Cruise ships, think about it. They're not saying, where's the hurricane? Because I want to go right there. We want to give these people a real experience today. Nobody's doing that. No cruise lines out there saying, where's the worst weather we can drive these people through? Because unless the boats are rocking, they ain't having a good time. So in trading, you're going to have those times where you navigate these storms, and that's going to prevent you from making money. And it may take money from you. And guess what? If you're not prepared for that, it sucks. And it's going to cause you to be fearful or not willing to take the same measured risk, the same setup that your model calls for the next opportunity that presents itself. You'll be too fearful of the last transaction's outcome. And you're going to immortalize the way you feel physically and emotionally, psychologically, every possible negative thought or experience about it, and you're going to place that in your journal. And now you solidified that as a traumatic experience. And now you have PTSD for something that doesn't kill you. Trading's not killing you. But I have friends that are no longer here because they allowed their results, not the market, their results, trying to chase Bollinger Bands, insisting that was the thing for it. And they didn't want to be here anymore because of that. That's not someone that's a bad trader. That's someone that's not in control and responsible with themselves. It would have been no different if they would have had their money and went to the casinos all the time. And the outcome would have been the same because they did not have a stable mindset. And their results in trading was simply the catalyst that would have happened with anything they would have done. So you have to be very guarded with your expectation, the influence you're receiving outwardly. The worst thing you can do is tell anybody you're learning how to trade. Don't ever tell anybody that, because you're going to get all the worst advice from people that don't even do it. They've never, never going to. Okay, so you've traded before? No, that's why I won't tell you to do it because I won't do it. Oh, every one of my family members said that. Every one of my friends said that. And you go online and you're asking strangers to give you their opinion about your choice of learning to do this. And they're the same people working at Jiffy Lube. Same people that can't make their bills every week and they're miserable. And they want to have someone feel like they listened to their advice. And that makes them significant. In this industry, everybody is a smartass. Everybody has a opinion that matters. But so few of them should be listened to. They shouldn't be listened to at all if you're really going to be diligent. You learn a method? Okay, wonderful. But while you're trying to do something in the marketplace, you should have no outside influence. Don't ask anybody's opinion. What do you think is going to be bullish or bearish? Unless you're trying to support the idea from a sentiment perspective. But let's be honest, most of you aren't doing that as a new trader. You're looking for someone that you think on a whim, they probably know what they're doing because they showed something yesterday, or someone's talking about this person made this much money. So therefore, I'm going to trust their view on the marketplace today, and I'm going to put money behind it. And if I make money, I'm going to tell my friends I made money. But you're not going to tell them you copied that person down to the letter of what they did. And that's shameful, because what you're doing is the same thing that everybody does when they kowtow and they follow the leader. I don't want follow the leader. I want leaders. I want people that go out there and say, I'm doing this on my own. I don't care that ICT isn't making any videos anymore. I don't care that ICT isn't doing mentorships anymore. I don't care if he ever puts his books out. I don't care if he ever does anything, because I know exactly what I'm doing right now. I put the work in, my results, I earned these results. So it is what it is. I don't need anybody else's outside influence. And guess what? That's exactly what I want all of you to have that. It's not arrogance. That's not conceited, pompous perspective. That's independence. That's confidence. That's something that you can't purchase, and nobody can take it from you. Nobody can take it from you. Who's going to take the ability for you to make money using a model that you have employed for months and years, and you stop working, and you're consistently able to weather the storm of losing periodically, drawing down, and then coming back out of that drawdown, and then coming to the point of net positive for the end of the year? You pay your taxes on that money, and you start a new year, and you do it all over again. Is someone going to be able to tell you anything when you're at that position? Who's going to tell you you did it wrong? Who's going to tell you what you're doing is wrong or it's not good enough? No one. You're not even going to give it a time of the day. You're not even going to worry about it. You're going to close these people, shut them down, and meet like, dude, go somewhere else. Ma'am, take it somewhere else. I ain't got time for that. My profitable students don't entertain the thoughts and opinions of other people. They don't even worry about it. But you're doing that in the beginning stages, whether you're learning from me or learning from someone else. You're like a sponge in the worst way. Any opportunity to have outward criticisms. You're thinking, I know I'm going to get some bad criticisms, but I might get somebody to say what I'm doing is good. And what does that mean? You're looking for a cheerleader. And in trading, you don't want a cheerleader. You want everybody to stay out of your damn business. Your business is your business. As soon as you allow and invite the opportunity for someone else to critique you, you might as well listen to everything they say. Don't be selective. Don't be selective and say, well, I like to see what they say about me once in a while. No, you might as well just submit to everything they say. Because if you've let your guard down and you take any influence from anyone else's expectations or opinion of you, you stepped out of the driver's seat and let them drive your ship, your car, your cruise ship. And believe me, they're looking for the storms to drive you right in the middle of it and laugh because you're going to have hardships, because they are living in a storm constantly. That's where they live. They live like that. And if they can ruffle the feathers or take you out of your comfort zone of consistently profitable, doing what you're doing, even though you're not 100% strike rate, your strike rate isn't 100%, you're profitable. Profitable students are not worried about other people's opinions. They're not asking their opinion about the market. They don't care. But in the beginning, it feels counterintuitive to not feel like, let me ask these other people that have more information about what they're doing and how they trade, because you think that's a shortcut. And what you're doing is you're feeding all of this. It's applying more cement. Okay? And your tears of frustration mix with that cement, and you build walls that you're going to have to break down, or they're going to be strong enough and formidable enough that you can't pass through, and you never arrive at the destination you have in front of you. When you first sat down and you want to learn how to trade, you had a goal in mind. I want to quit my job. Wonderful. Wonderful objective. Is it going to happen right away? Nope. Nope. It ain't going to happen. Eventually, done the right way over a period of time, you could get to that point. What's the differentiation between you getting there and not getting there? Bringing your circle of influence down to just you. If anybody outside you, that means your spouse, boyfriend, girlfriend, your present job, your friends and your family, people you know on the internet, or maybe the other people that you don't even know that just have the ability to leave comments in your timeline. If any one of those individuals or collective groups of people have any influence over you and how you think and how you feel, if you feel an emotional response to them, whether it's They give you a compliment, like, yeah, yeah, yeah. Bullshit. Get rid of it. If they allow, or if you allow rather, then to give you criticism, that they may say, this is constructive criticism. Okay, are you self-employed? Are you making the money outside of a 9 to 5 job where you are in a position where you can tell me your constructive criticism? Because you're not in a position to give me any criticism at all because you're not even doing what I'm doing. If you allow for that, you are inviting, laying the red carpet out for people to deter you from your objective. But it doesn't feel like that when it's happening. Because what you're looking for, just like when you tell your friends, just like when you tell your family members and your spouse, hey, bro, we've been going to school since so and so. We're friends, right? You know, we're tight. I just want to let you know what I'm doing. I'm going to be doing this trade and I'm going to do this. I'm going to do that. Okay. What's he going to tell you? Dude, I don't know, man. It sounds crazy. It's too much risk. I wouldn't do that. Yeah, you said you wasn't going to do that. And let's leave it at that. But what's going to happen is they're going to tell you every reason why you shouldn't do it, because what they're feeling is, oh, crap. They got a sense of desire to come out of where we're at right now. They don't have it. They don't have an avenue to get out of where they're at. They're content. They're complacent right now. Right where they're at, they're comfortable. And you made a decision that you're not comfortable where you're at. You need to elevate. And that decision to finally make a move to change where you are in life, and you want to go higher, you want more. And there's nothing wrong with that. That's not sinful to want more. That's not sinful. We're not supposed to live in lack. We're not supposed to have contention with ourselves and wrestle with, we don't have enough. Because if you don't have what it takes to take care of your family, that's horrible. And a person lives by their work. They eat. If a person doesn't work, they don't eat. Let me tell you something. Anybody tells you that trading ain't work, never traded before. This takes more work. I have surgeons as students, okay? Brain surgeons as students. And from their own lips said, this is the most difficult thing I've ever had to learn how to do. These people cut on human beings' brains and keep them alive. To me, I think that what they're doing is harder, but from their lips. But you listen to some jackleg ass on social media say, oh, you're never going to learn how to do this, or you'll never survive at this, or this doesn't work, that doesn't work. And these people don't do anything. They're working at Jiffy Lube. The guy listening knows exactly who I'm talking to. But the bottom line is this: you are allowing these nobodies to give you input that you're going to elevate to a level of importance when it's not important at all. Because you're trying to look for someone to cheerlead. Because you're thinking, I'm going to filter out all of the adverse criticism. If I get 50 comments that are highly critical, that it's going to be impossible for you to find success in any of this. If you just listen to find one that says, I believe you're going to do it, that's what you're looking for. And that's wasted effort and time. If you do that for yourself in your own journaling, you cut out all the bullshit. Think about how much time you listen to people that don't have your best interest in mind. These people on social media, they live for it. They're like vampires. And if you respond to them and you give them any energy back, you just elevated them up out of the mire of Jiffy Lube. They can't even get an overtime hour to pay for Netflix this week. But they're going to be on the internet hounding and constantly telling you, you can't do this or you won't do that. I've had lots of students that were influenced by other people negatively talking them down. And I've had students that had that initially, and I told them what I'm telling you here. Now they're profitable. What changed? The concepts didn't change. The markets didn't change. They didn't trade new models. They didn't go into a different market. They didn't stop trading one asset class and do another. They let no outside influence in. Because your spouse isn't going to believe you. Your friends aren't going to believe you. And your family doesn't want to see you do better than them because they are going through life just like you are. And they would like to win the lottery. They would like to have something better fall into their lap, but they don't want to put the work and the effort into it because they don't want to fail and feel like they wasted time, money, and energy. Whereas you, if you're still listening to this, you have the right mindset because it's feeding you. It's aligning your perception with reality that, yeah, this is hard. All this stuff is hard. But for the few that have the mentality to stick through it and work it out in their own, where their model is unique to themselves, they know when it should be used and employed versus when it shouldn't be. And they're content with that. They're not trying to trade every day because there's a market open. They don't care about that. And they don't care that they don't have a result to show with everybody every single day, every single session, every single market. Why don't you take that trade? Hey, Brian, why didn't you take this trade over here? Why didn't you do that? Hey, did you trade that one? Yeah, you showed that you traded this and you got a broker statement that you did that. But why didn't you take this trade over here? Why didn't you take this many contracts? Why are you still fucking working and you're asking me questions? That's your mindset. Maybe not use the superlatives and sentence enhancers like that. But you need to cut these people out. They're cancer. And if they're family members, love them from a distance. When you arrive at where you're at, then you can talk to them about it because nothing they're going to say to you at that point is going to have any influence over you. You're not going to say, oh, I better stop making money now because they didn't like how I did it. No one ever thought that ever when they talk to their family members. No one ever says, man, I regret having done all the things I've done to arrive at where I'm at because my family said they would have never expected me to do that. They never would have expected me to arrive at where I'm at. Would have been possible. If you would have told me then you were going to do this, I would have said you never would have done it. But they're going to lie to you and say, you know, if you would have told me that, I would have told you, yeah, you would. If anybody in our family was going to do it, you would have. Not one of my family members did that. Not one of my friends did that. Not one of them. And I gave them ample opportunity because I needed it. I needed that because no one was coaching me. No one was encouraging me. And I wanted to quit all the time. All the time. And if I would have had the ability to know in advance how to manage myself and how to filter out all the things, like I was using America Online back then as a sounding board to receive the encouragements from outside sources because I had hit the bottom of the tank with myself. Like I needed someone else to say, you know what? This is cool. This is worthwhile. I'm going to start doing what you're doing. And I was like, you know what? I'm going to borrow that spark of hope that they just seen in this because I can't see it right now. I keep messing it up. And by borrowing the enthusiasm of others on the internet in the late 90s, America Online was, that was the thing, right? Like that was the internet. My younger self, we watched the internet come up. All of you probably listening, you're young. You've always had the internet. You have a plethora of mediums and avenues to communicate and converse with other people. Back then, we really had just one medium. And then you had billboards and small little internet relay chat apps and things like that. And you had before cable TV, you had a television that had channel 11, 13, 2, and you had a UF, I forgot even what they're called now, but 54 and 45, and then you had the public channels 22 and 26, which even with a really good antenna, you still couldn't get them coming clear. That was the equivalent to what it was like when the internet started. You had very few choices. And then you had all these different browsers were starting to come out. Use Firefox and a couple other, something Scape or something. I can't remember what it was, but it was neat to see all these things coming up. And it was a wild approach to be able to talk to someone on the other side of the planet, real time, and it was neat. And you want to hear other people encourage you. And you want to encourage other people if it's in you to do that. And I'm an encourager. I went through adversity. I went through a lot of things, not just in trading, but a lot of other stuff. And I know what it's like to be down and out and homeless and not have any money and no one willing to help you and have no positive expectation. You're at the lowest of the low. You can't go any lower unless you're in the ground. So I know what it feels like to not have any sense of encouragement or any reason to feel like it's worth keep trying to do it. Keep trying to do it. Keep trying to do it. And my coping mechanism when I was 20 years old was to go on the internet. That was it. That's how I did it. And until I changed my perspective on why I was trying to do it, understanding how to do it. And I asked the Lord, I said, look, I believe if you let me understand this, I'll spend my life helping other people do it. And not only teach them how to do it, but I'll encourage them along the way. Because that's the missing ingredient. That point of sticking with it long enough. It's like exercise and weight loss and a sport. You have to work at it. It doesn't just because you like it. It doesn't just fall in your lap and you're good at it. It takes effort. It takes discipline to continuously work towards it. And in this is really hard. Like this is really, really difficult because you are the factor that makes it difficult. I have lots of students all around the world and so many different walks of life. They've had success in other things and they thought it was going to be easy for them to have success in this. And they found out it's hard. They had no success in anything. And then they come into this with low expectations, but high expectations in terms of immediate gratification, but low expectations in themselves. So they expected the concepts, myself, my ability as a mentor to transform them immediately, which is not practical in any sense by any measure of any field of study or mentor. There's nobody out. Christ can do it, obviously, but even he had, people that didn't want to listen to him. And I'm not trying to equate myself to that, but as a mentor, as a teacher, I wear my heart on my sleeve. Like I want all of you to succeed, even if it's outside of what I teach. I love hearing about people succeeding. I love it because I know what it was like before I found success, how I looked for that. And there was very few online that were showing anything that resembled success. And that's why I latched on to Larry Williams because he had something it was proven. He went out there and did, $10,000 and had over $2 million at one point. And I held a great deal of respect for that. And I motivated myself by watching the same tired ass videos. And I can repeat them verbatim still today. And they were made in 1994, released for publication in 1995. That's a long time, and I can still say that stuff before he says it. If you watched it, I can tell you what he's going to say before he says it, verbatim, because I had to listen to that. That was my coach. That was my encouragement. And today we have a lot of nonsense out there, a lot of self worship, a lot of people that want to be worshipped and looked up to for no real good reason. And I'm watching this price action. Don't get me wrong. I've been looking at price the entire time, but we're at the low end of that opening range. That's that shaded area here. Let me go back to we're already here. That closing price to the opening price. That's what was shaded here. So we went above. We created relative equal highs. We did trade up to that low here. Okay, so maybe Steve would have taken another trade to get in there and trade up to that point. Now, there you go. Jane, the trader that looks for turtle suit type things, she might have seen these as relative equal highs, failed to get to the midpoint. We broke down, and now we're below here. So we're at a really critical point where now the opening range itself can act as a premium array. Meaning, if we trade below it and come back up into a fair value gap that works in concert with the low of that shaded area here, that could be the catalyst to send price below that low, accelerate down to that low, which was those relative equal lows I told you at the beginning of the video. Let me show you again. I'll pull up on the 5-minute chart. With the electronic trading hours. That's these lows right here. Okay, so we want to see it trade down, create a fair value gap, and then go into that and then accelerate down. It's done enough for my liking post opening range. We made an attempt to get to midpoint. We created a relative equal highs, went there, failed, and now we're focusing on the low end of that shaded area. Because like a fair value gap where it can trade just to the low end of it and then go lower, we're treating it the same way. Let me zoom in here because it looks like it might be doing it now. If this candle right now doesn't come back up and touch that candle's low, that would be enough to create the fair value gap I'm referring to. If it comes back and trades to it right away, that's immediate rebalance, and then it could just take off and not create the fair value gap in this area like it just did here. We would have to wait for something below this. So you're constantly weighing out what it can do and what it will do. It could do this, but you got to wait for these candles to close. There's no inefficiency here now. It's already came back into that candle. So said plainly and simply is, as long as we don't take out this candle's high, any fair value gap below this opening range, I would like to see that be treated as a premium array and then send price lower. And how we trade at this area here would be indicative of how we trade down here. But once we get to this level here, I would be done with the expectation on the day. And I wouldn't care for what it did beyond that. So it builds a limit of my interest. My interest in this day is until we get down here. So how could I use that information? It could trade down here and give it an opportunity where it trades down to this level here and just pokes below these lows and doesn't get down to that blue level here. Okay, and then as long as we don't take out, it's not in price action right now, but whatever high that would be formed after it takes out these lows, I would look for that as the boundary in the afternoon where it shouldn't trade beyond that once it creates the new setup at 1:30 to 2 o'clock that would eventually trade down to here. So it's kind of like how I'm building an expectation. It doesn't mean that I'm saying, it has to do that. That's what I would like, and I'd lay the invitation for that type of setup. And if it was to present itself, I could take that type of trade because of all the things I just said here. Okay, but this is pretty much, this is messy in here. I've done nothing with it, but I lost my train of thought about what I was saying earlier, but along the lines of allowing outside influences, you have to be very careful with it. And in your journal, you certainly don't want to let other people's opinions, even good ones, because flattering lips, they're a distraction. They'll tell you when you want to be told you're doing good, when in reality, what you did to get the result wasn't probably in your model. It wasn't in a manner in which you should be proud of for the sake of trading the model, because it's outside the scope of the model. So you have to be very guarded in that regard, because it's very easy to talk yourself into being smarter outwardly than you really are internally. And I was looking for those types of things as a 20-year-old. And in today's society, with social media the way it is today, I would have self-destructed if I was starting in this environment, because I would have been looking for outward, pats on the back. I would have been looking for an attaboy, you're doing amazing work. I don't like those types of things. Still to this day, I don't ever like that kind of stuff, because I know what it would have done to me as a younger man, and I know what it does to younger folks today. They want to be worshipped, and no, I'm not God. I don't need to be worshipped. But I like to see appreciation. When I make an effort to try to spend my time, which I could be doing other things, and they get something from it. I like seeing that. Like, I like seeing that they got something very specific out of the time they spend with me, versus, you're the best, you're the goat. I'm not the goat. I'm not the greatest. I hate those types of things. But when someone's very specific and they say, you know what, this addressed an issue I had been wrestling with, and I feel like I got an approach now I can apply to try to combat that. I like those comments. I like that type of feedback. because it's very specific instead of just giving me a blanket loving response, which is what 99% of my comments are. Occasionally I'll get the fraud, you scammer, same guy, 15 different sock puppet accounts. But that type of feedback, when you're very specific about it, I might not like it physically, with a little love, heart thing on YouTube, but I read all of them. Like I read every single comment, and once a day I scroll through because they're like little text messages. Well, not all of them. Some of them are like books. I've done this and then this, and I would like to share what I discovered. Make a YouTube channel. Make a YouTube channel if you discover something new, and you want to share it. If you're willing to share it, let everybody see it. Because there's no limit to what you're going to be able to do with what I've taught you. Like I'm not at the end of it. If I had more life, I probably could do a whole lot more with what I got. But I'm content with what I have. I'm content with what I've shared, and you don't need everything that I've shared. You only need like a small little piece of it, and the rest is all you. And that's why I tell you, when you get your results, you need to take credit for that, whether that's good or bad. You can't take credit and say I'm Team ICT because it worked. But then when it loses, ICT is a fraud, or ICT stuff doesn't work, or ICT's rebranded this. They got an excuse for everything that justifies their shortcomings. So it's important that you own it. Whatever your results are, they're yours, and you should be proud of them. Even if they're not what you want them to be right now, you're making an effort to do it. That's more than 90% of the people out there. That 1 year after you start trading, if you took an inventory of everybody that started a year ago in trading, about 75% of them aren't trading today. They're not trading. And that's always been like that. And that same 25%, maybe 2% or less are even marginally profitable. And less than 1% are consistently profitable. So the dynamics of this is that it's so against you in terms of potentially profitable, it's easy to talk yourself out of it. So if you start with managing yourself and how you manage yourself emotionally and psychologically through the use and employment of a journal, that's the benefit of using it. It's your shield, and it's your record of how you dealt with previous experiences. And when you journal, at the top of your journal or at the bottom of your journal, some way that you want to track all your stuff, you want to, if you have a really good day where you encountered something and you learned how to work through something that was adversarial in your development, where you feel like you really wrestled something and you did something right, or you suffered something and you didn't get the expectation or results as you were looking for, and you sweet talk yourself in a way where it was very therapeutic for you, at the top of your journal or at the bottom of your journal page entry or log entry, you want to label this encouragement. Okay, and another part of your journal, like the far back, or maybe it's better to have it in the beginning if you're using a physical journal, where one section is you log key dates where you overcame an adversary or a dragon. You slayed a dragon that was plaguing you as a developing student or trader, where you've really made progress with something, or you overcome something, or you felt something that was a barrier, then you applied something that you learned from me or maybe someone else, and you now feel like you're victorious over it. It doesn't mean that that dragon won't show itself again, that adversary won't show itself again in trading. It won't plague you again. It will. But when you encounter it again, you want to go back to those same dates, okay? And you remind yourself what you did to get through it. Because when you're going through it, you forget everything. And you react impulsively. And what is that going to usually tend to be in trading? Trade recklessly or overtrade. Trade outside your model. And that's not what you should be doing. When you have a period of drawdown and you go through a period of canceling out that drawdown, you want to have a period of time where you cancel that drawdown out and the dates when that happened. So that way, when you go into drawdown again, say, hey, yeah, I've been here before, and this is what happened the last time. And each day wasn't always profitable, but I slowly grew out of that drawdown. You lived it. It's not like reading the Bible and these other people had those experiences and we're supposed to find faith and encouragement from them. You are recording these events in your life, and your children or the people that you have a circle of influence in, they have a record of what you did to get through that at the time. But when it's your experiences that you go through and you wrestle through it and you read it again, it's amazing how you can be right back in that moment again and feel like, I remember being really uncertain about that time and I didn't trust it, but I stuck with it and I did it. So now I did that. I went through the process of following the rules and what I was supposed to do and limiting the exposure outside of me, keeping all that stuff at bay. And I know I'll be able to get through this again. It may not be as short as a span of time that it took for me to get through it then. It may take longer, or you'll be pleasantly surprised that it gets faster that you go through it. But you shouldn't have the expectation like that. Speed is only welcome when you're trying to protect your money. Only fast movement or fast reaction when you're trying to protect your money. Everything else, you need to be moving in slow motion. And I didn't understand that when Larry Williams first mentioned that. But when you lose money, you blow accounts, that stuff means a whole lot different perspective of managing yourself. Because you think that when you lose, I want to hurry up and make it back. And the worst thing that can happen is that you do. And what did that do? It rewarded you doing something impulsively. That's not how you rewarded with me. As a mentor, I'm going to tell you, you did that shit wrong. You did it wrong, and you don't deserve any accolades for that. I don't care that you made the money back. You don't deserve the accolades for that because you have been rewarded monetarily on impulsive reactions to something that you should have stopped. You certainly shouldn't have used more risk because that's usually what you're going to do. Well, I only lost 15 handles on that and I was doing this, but I'm going to double what I traded this time because all I got to do is get half of that move and I can win it. That's backwards thinking. And when you're rewarded with that type of stuff, it solidifies it in a manner where you never think correctly about the market and your actions and reactions to what the market's going to present to you after that losing trade. You're just going to plow ahead. And every single person that blows an account has that moment right when they could have said, I'm not going to do that. But they choose to do it. And then they don't have an account at the end of that trading day or even that trading session. It's demoralizing, and it's avoidable, but you won't recognize how to avoid it unless you expect it, prepare for it, and have a process on how you're going to handle it. And you have control over that. See how we just came back up and took this little short-term high out after trading back down to the low of the opening range gap, which is shaded here. So I would like to see it move lower. If it can create a run displacement lower and then a fair value gap in that displacement, that would be enough. And then I wouldn't want to see that high taken out until at least this low was traded below. In other words, these lows here. So in my mind, we're looking at it like this. I'm looking at it like this. Let's say it that way. I haven't looked to see how many people are here listening. Probably not a lot because I'm going on and on and on. This guy's not even taking any trades. So that's in my mind. I'm thinking that pocket right below these two lows here. That's just too enticing. And look how many times they've taken it up. They've took out this high here, pressed through it, dug into that nice big imbalance on the downside here. Like that single one big news driver candle. We've had a rip higher, digging higher, create relative equal highs, dig even higher, but still failed to get to that midpoint. So that's what I'm saying. If we can find a way to trade below with some aggression, I would view that as we tried to get to the midpoint, but now it's proved itself heavy. So then any fair value gap after the imbalance that's created, or not imbalance, but the impulsive price move, it just displaces lower.
sudden drop, if it creates it where it's an easily discernible fair value gap, and if it trades up in a fair value gap, I would like to see that next fair value gap be treated as a premium array, and then trades to it and then aggressively leave it. If it does that type of action, these lows here would be easily traded to. And then if and when it does trade to these lows, because I could be wrong, but if it does trade there, I want to see, does it show a willingness to just expand and dig down below this level here? At that point, I would think it would want to have a sizable retracement back up into the daily range that's created thus far. So that's me building a narrative based on the premise of what we've seen so far and everything else I've said, okay? I'm going to extend this over a little bit because I want to see how it reacts and responds to the low of that opening range gap. The opening range gap's high, midpoint, and low are critical levels of influence algorithmically, but it's not limited to that. There's the lower 25% and the upper 75%. Okay, so the way you can do that is this. It's actually easier if I do it on the regular trading hours. I have been wanting to spend time with you all and talk and go over stuff and whatnot, but you know, when you're married and your wife's close to her mother, she was very close to her mom. She's taken it very hard. Um, I wasn't able to do anything but just be right at her beck and call. And it's because she's not here today, I'm able to do this. But I expected her to leave yesterday, and she stayed home because of her father not needing to do what he needed to do today. Um, it afforded me the opportunity to do so. So it wasn't like I was like, well, I'm going to dangle a carrot and say I'm going to share some time with you and then not do it. I don't have the care of your opinion of me above what my wife is expecting of me because she's going through something. So hopefully the adults in the conversation here can get what I'm saying. Family first. So here's the key levels whenever you have an opening range gap. Um, the high, obviously, it can always come back to that. And on a day that's bullish, we would expect it to trade there, fail to go through it, and then to run through it. And then the rest of the day you're bullish. Okay, so that's a real simple way of approaching that. Um, a really nice retracement, but leaving the gap open, would be trading back to the 3/4 of that range, being the highest point and the lowest point. And the lowest point is where we open at 9:30 on the new day. Okay, so where we stopped trading yesterday at settlement to the opening price at 9:30, that's your opening range. I'm watching price for the first 30 minutes. Unless I see something extremely convincing, I'm generally not trying to take a trade in there. But if I'm really sold on the idea of what I think it's going to do, many times I'll trade in before the 9:30 opening, because there are certain instances, and this takes a lot of experience, and it has to be like all the planets are aligned. Okay, I'll take a trade that's ahead of the 9:30 opening bell. But generally, I'm not. If I see something that I'm expecting to see in terms of directional bias, the news event delivered like I thought it was going to run for a particular level of liquidity. If it's ran liquidity before the 8:30 news, but not CPI or PPI or either one of them, I will use the run on liquidity, and then at 8:30 I'll use whatever it's been doing between 8:30 and 9:30. I'll be in sync with that and just expect the opening range to continue what it's done for that last hour. But it's a lot of things that have to be there for that to be true. So some of you probably watch me record my trades, or if you're students, you've watched me do these things where I'm going in like literally like 2 minutes after 9:30. So 9:32 or 9:37. And you see some of these folks on Twitter, they're saying he keeps buying at this certain minute all the time. Folks, don't listen to that. Okay. If you want to study it, you'll discover what I'm about to say is true. It has nothing to do with what I'm doing. I mean, everybody wants to come up with some kind of way of what I'm hiding from you. I'm not hiding any particular thing. I'm not always buying at a specific minute. I'm not always selling at a specific minute. There are time windows that I'm looking for. Yes, that's true. They're macros. But I'm not always trying to do these very specific minutes. There's specific minutes I'm expecting price to do something, but I'm not always entering at a specific minute marker. Okay, so please don't let anybody convince you that that's what's going on, because I'm not doing that. Okay, I am looking at what price should do relative to a specific time, and it may be at a minute, but I'm not entering at that minute because of the sake of that minute being what it is. So I'm saying that there are time windows. Some of them are 10 minutes, but most of them are all 20-minute intervals. But I'm not ever entering at one specific minute that's always repeating, always based on something. That's not occurring. But there are minutes in a session on a specific day, on a specific calendar day or month, that it should do specific things. So in that regard, there is some truth to the expectation, but I'm not entering based on a specific minute marker, a specific minute always because of something. If it looks like that, I promise you it was only coincidence that it occurred. Because if you look at every single one of my examples of entering a trade, that doesn't hold up. Okay, so anyway, and then we have the midpoint, which is always an expectation. Always, that should always be shown to be a reasonable return back to that, because it's half of the gap. It's also indicative of telling you whether the market's going to have a large range day or a trending day, because if it can't get up there on multiple instances of trying to do so, then it's heavy, and heavy means it's likely to go lower. So if it's going to go lower, where do I, as a trader, as an educator, as a mentor, where's my focus? I want to see it reach for some inefficiency. So if we look to the left of where we are in regards to this, there really isn't any inefficiency. We have this little thing here, but apart from that, it's this gap, and then the lows that formed on the electronic trading hours that we're not seeing here because we're looking at the regular trading hours. So I would rather side with it once it go below the lows formed on the electronic hours chart here, these lows, and then if it can go below that, what I outlined at the beginning of the majority of the beginning of the session we had today, where that trading range we've seen. So I think there's a larger pool of sell stop liquidity resting below there. And we'll go back into a 1 minute chart. So all in all, I mean, it's been a rather one-sided move since that news driver came out. But basically, we've been just marking time. But it's respecting, okay, the quadrants of that opening range gap. This was the high of it, upper quadrant, or the 75% level of it, half of it in the lower quadrant. Look what we've done here. Look at what's hitting here, here, sweeping a little bit here, consolidation around it. One more spike just to get all the liquidity out here, and then we drop down. Where are the bodies? Right at the low of that opening range gap. See how it's respecting that? So on a day where it's not so heavily manipulated like we have here, PPI and CPI numbers, they're train wrecks. They're convenient excuses why you no longer have your account, because there's a lot of movement. There's a huge amount of movement that's available to you. That's why they increase the margins, because they know somebody is going to get lucky and over leverage right before. And just randomness alone would allow for them to have, if they're booking the customer, they would have to pay that out. So that's why you see the margins increase. And the risk of chance guessing if they over leverage is sizable. That's a huge amount of range here. If someone was able to get in there and just go short, this little run here, if you're trading without a stop loss and it doesn't allow you to get swiped by margin, and it happens so quick, you probably would have evaded it. You can ride that out if you're gambling, and I'm not suggesting or making the invitation to do so. I'm actually speaking against it. But in that short span of time, a B booking on the part of a broker that's allowed for over leveraging, not in the sense that you're over leveraging because they're giving you $300 margin like an AMP or something like that. Even an AMP, they raised it up. But someone could easily be over leveraged here and get lucky, and that over lucky gambling puts them at exposure if they're booking a client. And they never want to open that up to the maximum level of leverage. Whereas in any other given day, if the trader's proven themselves unprofitable, sure, have all kinds of leverage, because the chances of you not seeing a big run like this, you'll just kill yourself by 1,000 cuts, and they'll just sit back and collect it with commission fees on top of it as a sugarcoating. But I'm going to remove this here. The creation of all these little short-term highs, and each one of them being taken out. I look at it this way: between the midpoint of the opening range gap and the low, which is the opening price at 930, that range, okay, that range at which defines that opening range where we previously settled and where we opened at 930. If I'm bearish, I want to see something in the lower half. I want to see something form in here that makes sense to me logically, that it's framed a setup, it's taken individuals that want to chase price lower, which is what everybody would have wanted to do. I mean, we've been running lower at 930. Everybody wants to go short, and they give them this little bit of like that. So what are they going to do? They're going to chase it. So they're short heavy in here and all through here. And then anyone that's short had a stop loss, they took that, they drop it down. Okay, that was the real high. Then back up, but then it doesn't take higher high, and they leave this high here. So what are they doing? They engineer what? Sentiment in the same vein that they think that this is now bearish and we can't go any higher. They run it one more time to do what? To take the stops that have been afforded to them. So if they've taken these buy stops that were right above here, why would this be important or influential to future price action? Because if they've done what I'm outlining here, which is create liquidity above these highs, and they ran that here, so now they have a book that has no longer short. They knocked them out of their seat, and their buy stops, some entity out there could be net short inside of this area here, specifically right there. So if they're short there, what would be a reasonable area to anticipate them wanting to get off that short? Because I mean, think about what's the necessity of going up here to knock out anyone that wants to be short? So if they've taken them out and they've assumed their short position by knocking out their buy stop, because to protect yourself when you're short, you place a buy stop. Where are you placing a buy stop? Where the books tell everybody to put it. Above resistance, because they see this as classic resistance, or above an old high. Well, we have both of those here. So if someone is short here, where would they want to take their profit? At a discount level. Well, what do we have in availability for that? We have this low here, which was the first drop lower after 930. So because that's there, we know that right below that low, that's a nice pool of liquidity for anyone that did get fortunate enough to go long there. Their stop loss is right here, and they're hoping that this is just going to climb all the way back up. It could. Broken clock is twice right a day. But here, this is sell side. So this area, I'm going to be very careful about putting all these lines on here because I got to explain to you what I'm doing. The buy stops were taken here. There's sell side here, and there's a small little gap right there. You see that? Everything else here is pretty efficient. It's been back and forth, back and forth, back and forth, and coming back in. Every little fair value gap has been overlapped. So below this low here, and what's to the left of that? This low. So there's relatively equal lows there. So there's a pool of liquidity in the form of sell side there. And then below that, we have this inefficiency. Even if they were to take out just these lows, it could spike down into that if they are not taking these lows out today or this session. This would be reasonable to anticipate price reaching to that. So in your charts, you should have that noted. In the event that if we do take out that low and this low, that's where you could identify a level beyond the scope of just taking the sell side. How far can it reach down? there. And it doesn't necessarily have to take that out, even though in my opinion, I think this is suspect and they probably want to take that later on. And we might need to go back, take this high out once more, one more pass through, because lunchtime hour usually will do that. It'll run back, take those stops. Now, nobody wants to be short, and they really built their book heavy. No one's short, so now they'll take it lower when no one's riding it. And then they'll take out the lows there in the afternoon session. So it's a lot of, it's like plate spinning. You know, you ever see a plate spinner? Guy takes a stick, like a dowel rod, and a plate that you eat dinner off of, China, and he spins the plate around. He's got 20 or 30 of them up on the stage, and he's running around constantly keeping all the plates spinning without one of them falling and breaking. When you're watching price action, when it's in a consolidation like this, it's many times like that. And if you're not very versed in trading, if you're not knowing exactly what you're looking for, and you don't have the discipline to sit on your hands and wait for something that's solid, it's better for you to turn the charts off and don't even look at it. Because these days here will chop you up. They'll grind you down. You think every little setup is going to be the thing that pans out, and it's not. It's very frustrating. So if you haven't already noticed, this is my observation so far for the year. I'm finding that the majority of the move is being completed by 10:15 a.m. And then it usually goes ugly. There's a whole lot of really good, clean price action after that. To me, that's not the algorithm being changed. They're not recoding the algorithm, or they change the algorithm. That's not what that is. What we're seeing is the effects of what's going on right now. We have all this wartime stuff being clamored about. We have all the economic problems going on. We have people flooding into our country. They are allowed to carry guns, but citizens are not allowed to carry guns. They're getting away with murder and getting $1 bail. All these things are there. It's heightened risk, huge heightened risk. It's an election year. We have potentially a powder keg getting ready to go off in the Middle East, and that's going to draw military response in our theater. We'll enter that theater as well. China's about to take Taiwan. All these things, okay, are huge risks, and there's a lot of money building on the sidelines in cash. Yeah, Bitcoin's gone up. Yeah, cocoa's even gone up better. And I said that before, and I'm going to twist that knife right now. Every single year, there's a mega move. Okay, a mega trade. These commodities always will have something that will outpace percentage-wise that Bitcoin run. Okay, Bitcoin is just doing whatever it wants to do. I would still never trade that thing. I don't care if it goes to 1 million. I don't care. The outcome is going to be demise. This commodity market will always exist because it's the grocery store of the world. Okay, and when you see the markets go into a premium, and we watched this in my private mentorship, we watched it go into a premium market last year. But just because it goes into a premium doesn't mean it's immediately going into a parabolic bull market. It needs to start doing it technically. So fundamentally, when the contracts were trading for more money nearby and farther out distance, it was cheaper. That means there's a huge inversion of supply and demand, real supply and demand, not supply and demand zones, because that's bullshit. But in deference to real fundamentals of supply and demand factors in the commodity markets, they are trackable because of the price, the backwardization that creates these parabolic price moves up. Many times is acted upon and instigated by these contracts that are sell by in the nearby like right now, if you're trading cocoa's nearby contract is May, so the symbol would be K. So you would put in CCK2024, and then when K expires, you'll be trading the July contract. So if you're looking forward, okay, if you're looking for big type of move like these parabolic runs that you all are expecting to see every single day when you're looking at Bitcoin, you get one of them every single year in the commodity market, at least one. Could be as many as 3, but usually there's always one big parabolic run. If it's in association with, and I apologize, you guys can hear no matter where I go, because there's 4 guys around the house right now blowing all the stuff around they just cut. So you have to deal with it. I apologize. But the backwardization of these contract prices, if you ever see a commodity price more expensive on a nearby contract, and it gets less expensive going in the future as you further away from where you are on the calendar. Like for instance, July's contract, normal carrying charge market, it should be a higher price at settlement each day than the May contract because it's more money, more costs associated with producing, storing, maintaining that commodity. And it's really apparent when you're dealing with an agricultural market like cocoa or the grains or livestock. When you're trading those futures markets, it has a huge influence over what the market's going to do. But if it ever reverses where it's more expensive in the nearby contracts and gets cheaper in the future, further in the future we go away from the calendar date that you're trading, that's a backwardization. And that only happens when there's a fundamental squeeze on the supply that's available. And what happens is when that becomes in agreement with it technically, you have what you see in cocoa. Well, let me show you what I mean real quick. Okay, that's cocoa on a 1 minute chart. You want to be trading S&P and NASDAQ with moves like that. Okay, and if you're looking at it on a daily chart, this is what it's done. And you love Bitcoin. Every year I told you, if you look at, listen, I put those core content lessons that I told paid membership students that were fanboying, oh, Bitcoin, Bitcoin, Bitcoin. And then you got to go through these long periods of drawdown, or not drawdown, but periods of consolidation. And that, to me, it's very frustrating. I don't like that. But when you looked at the fundamentals and you saw that where they grow cocoa, there was a lot of influence over the utilization of labor and child labor, and they were trying to do a lot of things to stave off that, and it caused a lot of problems with it, and they couldn't move cocoa around. And a lot of other things too, you can study it, but we were looking at it last year, and I said, look, cocoa is in a premium, and we can be watching it. And if you're a mentorship student, you know this, but I did not say buy cocoa. I was saying it was in a premium, but you have to wait for things to get technically in line with it. And when you have that premium, where the contract months in the nearby going to the distant are more expensive in the nearby, that's a reverse of what normally happens. A carrying charge market is when you always see the prices of the nearby contract be less than the further out distant contracts. So as it relates to cocoa, it would have been May contract is nearby right now, then it goes to July. So July in normal carrying charge market should be more money, and it's not. It's less because of the reverse or backwardization that is created by it's called a commercial bull market if you studied Larry Williams stuff. And that's why I tell everybody, even that book, it's written in 1973 or whatever, it still holds true today. And he didn't develop that stuff. He learned it from his mentor, and it still holds true today. But the market still has to be technically in alignment, not just simply because it can be months where the front month has a higher premium because they're buying it up. They're buying it up. And the people that use cocoa for like chocolate, whatnot, or candy bars are going to start costing a whole lot of money. Anything that uses cocoa is going to be expensive. The issue that we had in Baltimore, in my state, we're a huge port for automobiles, coal, and sugar. I'm watching sugar prices because this could be a factor months from now where it causes sugar to do something like this. So I'm just getting it to you free of charge. But if you're looking at the Bitcoin or cryptocurrencies, and you think that that type of parallel move happens only there, these types of moves happen every year. Every single year there's a big mover if it has a carrying charge market where it reverses. Okay, doesn't mean you can't have a move like this in reverse, but that's usually when a market doesn't have it has a carrying charge market, but not a premium commercial bull market where there's no backwardization between the front month and the distant month. But this type of move here, this destroyed Bitcoin. Okay, on leverage, if you had one contract and then you wrote it up above 10,000, it absolutely destroyed Bitcoin. And Bitcoin looked pretty. It ran up there nicely, but it still pales in comparison on percentage basis and what you had to use to trade it. But back to NASDAQ. Just want to remind y'all what am I doing here? June contract. And 1 minute chart. Can you tell I'm having fun today? I'm enjoying this because it's a pleasant distraction from all the misery it's been with watching my mother-in-law pass away. Cancer is a disgusting. Ugh, it's obviously from hell because no one should suffer like that. But I baptized her in Jesus' name for remission of sins, like 9 days before she passed away. She was aware everything was going on. She asked Christ for forgiveness, and it wasn't but a couple days after that she went straight down, and then she was taken from us. So in a lot of ways, I'm at peace about that. But my wife is still, she's without her mom. So while I'm trying to find my way back into the swing of things until the end of this year, that's unfortunately what I'm contending with in my personal life. So if she's around me, I can't do anything. My personal students don't hear from me. I'm not on the internet making videos. I'm not doing anything except for being a husband. But I needed this break today. Like I really, really needed it because it's been hard. Like I watched my grandparents, fizzle away. More specifically, my dad, my grandfather, who was like my dad. Cancer took him out, and to watch her mom go out like that, it's not something anybody should see. And I had a lot of people send condolences and also personal thank yous, and you know who you are. Thank you very much. They didn't send me thank yous, rather they sent us personal condolences without trying to draw any special attention, which I'm not trying to do. You know who you are, and we appreciate you. Thank you. All right, so we have price trade up into a fair value gap with a bearish order block, and we're sitting right at the low of that opening range gap. Now here is one of those times where if it does this, I'm done. I'm not looking at it anymore. Since we came back up here, this is essentially enough of this run here. So if you look at the bodies from this highest one here down to the lowest one here, if you look at, I'll put on the fibs, you can see what I'm referring to. Why are you using the wicks here in the bodies, and why are you doing this and doing that? It's based on using both of them, okay? And if it aligns with an expectation or a narrative, since I'm expecting price to want to go down here, that I've maintained that all throughout this morning. I've not deviated from that. I'm not interested in going up. I'm not interested in trying to buy along. I'm not trying to do any of that. I'm looking for something to allow or afford a framework that allows price to present a setup to study where it reaches down below these lows, stab into here, and if it accelerates through that, then we can get down to here, and then we judge and watch and see, does it want to go through here, and then make an attempt to go below that low here. That's where the largest pool of liquidity is. That has not evaporated. The largest draw liquidity is this 18,006 level, okay? We've created this run on the buy side there. We've ran below these lows, consolidated all around the bottom of that shaded in pink area. That's the opening range low. We traded up into inefficiency here, and look where that was, right at the 50% level using the bodies. Because the bodies is telling you the bulk of that price run is linked to those parameters. That's the outside boundaries. But because the wicks are always where the damage is done, that's where they reach beyond the scope of what would be reasonable, which is, in my mind, I use the bodies of the price swings. But I afford myself navigation within that price run by utilizing and measuring the wicks. But if I'm measuring in terms of premium to discount, or if I'm using ranges where if there's a whole lot of spiky price action where we only had just one here, I use that as, well, that's errant price action. It's something that I'm not going to attribute a whole lot of emphasis behind. So I'm going to look at the bodies here. I'm going to measure that. If I measured using the highest wick high and the lowest wick low here in that price run, it still affords me the same price level. But even if it didn't do that, I would side with using the bodies. So in this case, it gives me both the same perspective that we're trading back to equilibrium. When bearish, that's the same thing as being short-term premium. And I'll say that again. I said this and taught this in the free content that's on my YouTube channel, which was paid mentorship, core content. That lesson where I'm teaching premium and discount, equilibrium, based on your premise, based on your bias, based on where you think the price is going to draw to, okay? Equilibrium can act as support or resistance in retail perspective, but it is premium when it's bearish, when it goes to the midpoint. So equilibrium is premium here. And, or if I'm bullish and we trade up above it and trade back down, that could be discount. It doesn't need to trade below equilibrium to the lowest end of the range that I'm defining for discount and premium. So it's a matter of knowing what you're looking for and then framing the equilibrium level based on that premise. So plainly said, if I'm bearish, the midpoint, if it retraces back to that, that's enough to act as overbought or premium. I don't need an indicator to tell me that, okay? By having this understanding, we don't need to have a Williams percent R. We don't need to have a stochastic or RSI or CCI or MACD. All of that stuff is outside the realm of necessity. Knowing what range you're in based on time, everything becomes apparent when you look at it that way. And then if you have a PD array like we have here, and it joins with that same idea, then okay, then this now becomes an important high where it should not trade above that before taking the sell side or reaching down here. And then if we do that, it should accelerate down here. That's what I'd like to see. This is the extra. The low-hanging fruit is there. The plus or the extra credit would be if it trades down here and you're short, you leave something on as a runner. Don't close the entire trade off and let it try to reach down to here. So you can see everything I've talked about today and then looking at and formatting it where now we're getting a run below the low there. Let me take that off. We've already outlined what I'm referring to. Extend this over a little bit. So now where we are, I don't want to see it trade back above here. If it does, then we're going to spend the rest of the day trading back above this high and maybe even retracing a little bit. And that's not something I want to be a part of because we're so close to this level here. I'm filtering out any other setup because to me, I'm more comfortable looking for a short down here. And it's convinced me that it has done enough to knock out the shorts by taking that run here. They've accumulated them. I told you that this low is in relative price to that. So really, essentially, it should be like this. There's your relative equal low. So there's a smaller pool of liquidity in the form of sell side there. And it would be reasonable to see it want to try to trade down into that. Right there. Okay. And how much further can it go beyond that? If it goes below it, if it doesn't want to take these lows out here, but does want to take these lows out, how far below that low can it go? And that's when we refer to this fair value gap right there. That's why that's being denoted on the chart. So everything has now been explained. Where we are right now, I'm not interested in seeing anything that takes out this high. Now, if we take out that low where it's shaded in blue, where I said the largest pool of liquidity is, if it went down below that, it could draw all the way back up to here, and that would be something I would expect. Not something I would trade, but I don't expect or want to see this high taken out until at least these lows have been taken out and make an attempt to get into here. Then you watch and see, does it want to trade down below here? So how could you use that? Well, if it gives you an opportunity to take a short, you would take a partial here, a partial here, a partial here, and then you leave a runner. You probably hear my stomach, I'm fasting, so I apologize, I'm hungry. But this would be your, like, the best case scenario, or like the absolute best in terms of the setup for targeting purposes would be that blue line here, because that's the largest pool of liquidity on sell side. Because since March, that's where all of the resting sell limit, sell stops would be, in all the bullishness that markets has been producing. It's thinking like, well, what if you don't have enough to take partials there? Then you have to come to the conclusion that, okay, what am I willing to take based on what your risk would be? So if you entered a short and you don't have it yet, by the way, the the idea of where you start, if you're brand new and you're not finding some consistency yet, or you haven't found any understanding yet with using the concepts I'm teaching, as soon as it trades below these lows here, you would take it off there and then monitor it and paper trade it basically, in your mind without having a demo account. See, paper trading is not demoing. Demoing is actually executing, and you have something that you measure your actual entry, to stop loss, the targets. Paper trading is what we did before anybody had a electronic demo account. Back when I first started trading, like, you had to phone your orders in, and there was no paper accounts. That didn't happen. You literally pretended by writing down where you thought you would get in at, and that's up for debate on how much you want to fluff it up. So I always use the worst case scenario. So at the 5 minute time period where I'm assuming that I would be entering, I used the worst possible fill that would have been available in that candle. That's how I did it. Because that's about what's going to happen when you try to trade. Because when you're beginning, you're going to wait for a price to move in your favor. When you've seen something form, the rules say do it. But then you're going to sit there and watch. Let me see if it would move in my favor. If it does, and if it does, okay, yeah, it's done. Move 12 handles. Let me get in there. That's about the reality of what it's like when you're beginning how to do this. Whether you're using my stuff or anybody else's, you want to be comfortable, and you have to learn to be comfortable being uncomfortable. And I'm going to say that again because it's real important. In trading, you have to grow comfortable with being uncomfortable. Not knowing the outcome is always going to be there. That's always going to be there. Now, I like what it's doing here. I like the fact that we wicked up. I'd like to see it break lower. Doesn't mean it will, but if it breaks lower, and that would be displacement. Any fair value gap from a run from where we are now, and not before taking out these lows. If it runs and takes the lows out here, then that's a wash. I'm done. I'm going to kill the stream there. But I want to see a fair value gap form between the bottom of that shaded area in pink and before these lows are swept or traded below. So if it makes a run right straight down to it, that's just something that's going to happen to you. You don't have the opportunity to participate in it. Well, why won't you sell short here? Like, why wouldn't you want to sell short here? Because that's not my model. That's not what I would take a trade on, because look what it's leaving right here. You see that? That's enough for it to start to drop a little bit and then come up, bang that out, go into that very fair value gap and complete that volume imbalance there, and still take out the trailed stop losses, because someone's short here. And now they're looking for it to drop here. And then they'll see that as, well, that's resistance. That's what we saw over here. It just failed that time, but it's going to work now because I'm in a trade. So I look for how retail would interpret price action, because I know that that's usually the crowd that's going to get stopped out. And I don't want to trade ahead of something like that. And if it's available, I will trade when they get stopped out. So what do I mean by that? Well, that would be seeing it run up in here. I would anticipate this little shaded area. See that change between the body here and the body there? Let me zoom in a little bit. There's a small little separation between that opening price and that closing price. Look at the closing price on that candle, 18,140. Oops, 18,152. And then the opening price here is 151. So it's a quarter of a point, okay, or one tick. That's still a volume imbalance. It's a separation between the two bodies. So if you're going to highlight this fair value gap here to here, you got to go back to that candle's close, because that volume imbalance has to be incorporated in the fair value gap. This price action is not easy. Okay, it's not like a clear, simple little market structure. Everything goes right to a simple imbalance or run stops and then runs right away real quick. It's hanging around. It's stagnant. It's a lot of give and take. And unless you are very, very dialed in and fortunate to get the right one and specific about where you're getting out at, these days are extremely challenging. And while I don't usually have an interest in doing what I'm about to say here, I'm probably going to do it if my wife doesn't come home beforehand. I'm going to go back and look at some of the individuals I'd like to see when they live stream and see what their results were today. And I'm not trying to say I hope they failed, and I'm not saying anything bad, but I'm not going to be surprised. I'm never surprised when they're honest and they say, this is a really hard day, or and many times if I'm listening to them and I see a day like this, I'm nodding. I'm saying you're feeling exactly what you should feel. And if they didn't overtrade or if they didn't take a trade at all, to me, I think that they should be patting themselves on the back because you don't want to force something in a day like today. It's very, very difficult because there's bait being offered all the time, even using what I use. Okay, like I see this. This is obvious. Okay, but they can get real close to it today, or not even go there at all. And by understanding that, just simply because I think it's going to go down there and I have years of experience doing it, in no way guarantees it's going to go there. But I have to have factors in line that build on itself where it allows me to trust, oh yeah, it's there now. It's not there yet. So when I'm explaining to you what I'd like to see and what I don't like, hopefully that helps frame why it's not always important for you to be pushing the button. Just simply because you're in front of the chart doesn't mean anything. We've been here, what, like 34 minutes or 35 minutes after 8. Yeah, so we've been here for a little while, and nothing has been real clear cut. What I'm waiting for and the setup that would align with that hasn't formed yet. And you, as a trader, you're not going to be comfortable with this. You're going to get impatient. You just want to get through it. Give me something. Let me get in here and see what happens. And that's when you lose money. So this little imbalance right in here and taking out these relative equal highs, I like to see that happen. And then if it can reject that, that's even better. Fix that. That wasn't right. But if it runs to this and above it and takes out that high, no longer interested in the day. Not coming back in the afternoon. I would like to see it trade later in the afternoon, down to here and then take out these lows. And if it can accelerate down there, that'd be cool. It'd be nice to say, well, it did it, but I wasn't part of it. So that's still encouraging for a student if you've never seen anything like that. If it pans out, oh wow, it did reach for that liquidity. So we had an expectation to see it trade there, but like every other trade that forms in every other market you're not trading, you can't go around saying, oh, I didn't take that trade. That's like saying I didn't buy the winning lottery ticket that won in the state that I live in, but somebody else won it. You can't assume that that was going to be you winning it, and you can't assume that you were going to participate in it. You may have been distracted. I could have been. It could have ran when I was showing you the cocoa chart. I could have missed if it moved and created a fair value gap. It could have happened then, and it would have been unfortunate if it happened that way. But you're not going to be in every move, and you can't expect yourself to be in every move. And you can't beat yourself up because you weren't in the move. So you can only make yourself available for when you have trading times, operating hours, and you have to limit your exposure to the markets to what you're able to do and live in those moments. Don't look at, oh, if I was up during London, I could have done that. Yeah, I don't even wake up for London anymore. I'll be 52 years old. I'm finding myself wanting to go to bed at 9 o'clock now. Like I'm entering my fall of my life, and I think I fell asleep last night. Hold on one second here. Well, that's my wife. She came in. I just asked her to take the pups out. So she took them out of the kennel and she's outside on the phone with our pool company. So that's going to end our session here today. I apologize. It wasn't all that um, eventful. If the price action would have been more accommodating, I would have done something for you. But I don't know what her schedule is going to be because she's going to tell me when I get off here. So I don't know if I have something available before we close this week out. But if I do, if I have time, I will gladly, because I enjoyed having time to talk with you today. But I can go in and again start another live stream. But I can't promise when that is because I'm at the mercy of what she needs from me. So in closing, I'm going to say this: watch and see if we trade up into this little white shaded area. If we trade there, but not above here, trade here and then drop lower, take the sell side, trade into this fair value gap here. That would be a partial. In other words, I would like to see it go below here, but also just touching that line right there, but one tick above it. I would have a limit order above that in a demo account. Okay, that would be a first partial for me. Then the second partial would be the midpoint of this wick here, or consequent encroachment. I don't need it to go below the low. Okay, why? Because the bodies are closer together. It may not go below that low, but it could go down to the consequent encroachment plus one tick above. So partial number two. And then the best case closing scenario would be down here. So that would be the close of all my interests for being short today. Anything other than that, okay, you can say it this way. If it trades here, I'm not taking it. I'm not even putting it in a demo account. But assume for a moment, based on what I'm saying, I would go short here. Stop loss will be up here. Yes, it's a lot, but I'm not over leveraging. I'm not trying to tell you to over leverage. And that's how I would treat it. And then I would look for what I just said here. And once it takes out the fair value gap here, the stop loss would be at plus 10. So I would lock in 10 handles. And if it's stopping out at plus 10 afterwards and then went down here, who cares? But that's how I would look at it the rest of the day based on what I'm looking at right now. Everything can change when I get offline, but that's how I would treat it right now. Okay. So that's it for today. I enjoyed, jawboning with y'all. I needed it. I needed to be able to have this sooner, but I couldn't do it. So that's life. That's what it's like being married. And I guess that's the breaks for today. But until I talk to you next time,